like this. I 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 like this. Feels so good.
Bruh.
Do you like it hot? Do you like it fast? Or do you like it slow and soft? Oh, do that one again.
I like this. 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 I like this.
Hey, creators, welcome to the really early stream. Happy Friday. And I don't know what you could have expected, man. Like, really. I mean, are you surprised? I don't know how. You must just not be paying attention to anything. But I think it is appropriate to start the stream. Soon, Jerome Powell will be speaking, and we're going to tune into him like we did. We'll be looking at the quad screen, the S&P 500 futures, the DXY, Bitcoin, and gold. We'll all be looking at those prices while Jerome speaks. And but currently, we're going to look at the DXY on the big screen right now until he gets to the podium. No idea why he's talking again. It's pointless. It really is pointless. All right. And here's your US dollar. The wrecking ball, and here he comes. All right, this is your US dollar. Let's get into this.
Events. It's also governors in 9 years, so 7 years. So in 9 years.
What's he doing, dude? Oh, he's like, oh.
So we started
Sorry, man.
listening sessions around the country that brought together people and organizations representing businesses, low and moderate income communities, workforce development enterprises, employee groups and unions, community colleges, retirees, and many others. We wanted to hear directly how our monetary policy decisions were affecting people's daily lives. So then the pandemic comes and upends everything, the way we work, live, learn, and conduct business. And we kept these conversations around Fed Listens going. And we thought we gained valuable insight, which continues to help guide our policy decisions. And I also think we delivered good transparency about how the Fed works to the American people through this process as well. So these events have now become a permanent fixture of our broader outreach. And my colleagues and I remember, I'm sure we remember each one of these events that we've been part of. They're really the real life embodiment of our policies and the way they affect the people that we serve. And they do inform our thinking as policymakers. So we continue to deal with an exceptionally unusual economic set of disruptions. As policymakers, we're committed to using our tools to help see the economy through what has been a uniquely challenging period. The insights you share in these events help us to home in on the challenges and opportunities that are shaping what we might think of as the new normal of the American economy. And it'll inform us as we try to get there. So my colleagues and I are very happy to hear from our participants today, to host those of you who are tuning in to listen, and to do the work that we do on behalf of all Americans. Thank you. And with that, I will turn it over to Governor Bowman, please.
Thank you, Chair Powell. Good afternoon, everyone. And I'm so pleased to be here with you all today in person to moderate today's discussion. And I just want to express my thanks to all of you for your willingness to travel to Washington, D.C. to be with us here today for this Fed Listens event. Over the past year, we've held a dozen Fed Listens events across the country, hosted by our reserve banks. And we found these conversations to be a very valuable resource for us as policymakers. Hearing directly from people in different communities about how you are experiencing the economy helps provide important context for the economic data that we consider. These discussions help us develop a richer understanding of how economic conditions are impacting people in their businesses and everyday lives. And it helps us think about how we can best achieve stability and support for the economic well-being of all American families. Today, and in other Fed Listens events over the coming year, our intent is to shift the focus of discussion toward understanding how the pandemic experience has reshaped the economy and the workforce, and the challenges and opportunities that we will face during the transition to the post-pandemic economy. So with that, let me turn to our first set of panelists, who bring with them direct knowledge and experience of how the economic landscape is evolving for U.S. businesses. They represent organizations that include small businesses, manufacturing, supply chain management, and the hospitality industry. I know that all of you have experienced firsthand the extreme economic and financial hardships brought on by the pandemic. And during the economic recovery that has followed, you've likely also seen rapid and substantial changes in supply and demand conditions in your industries and in the communities where you live and work. Given those lived experiences as business leaders, we are especially looking forward to hearing each of your perspectives. And as we hear from each of you, I'd like to invite my colleagues to follow up with any questions that they may have. So let's start with our first panelist. I'll introduce Tom Henning. Tom, thank you so much for being here with us today. Tom is the CEO of Cashway Distributing, a wholesale distributor of food products for convenience stores and food service establishments in the Midwest and the Great Plains region. Cashway began in 1934, delivering candy to local grocery stores in Kearney, Nebraska, and the company now manages an inventory of over 20,000 products. Cashway has remained privately held by the Henning family, with the second and third generation family members involved in the business today. So Tom, for our first question, could you please describe how the pandemic changed the demand for transportation and warehouse services? And to what extent are shortages of material and labor still affecting your business and industry?
Thank you. The pandemic changed demand for transportation and logistics services in some manners that were expected and some that were unexpected. After the pandemic, we expected a fair amount of pent-up demand that would be released, and it was. In fact, probably the demand that existed out there was greater than what it was pre-pandemic. But what wasn't expected next, before the pandemic hit, was the demand for workers would exceed the supply by a larger margin than what existed pre-pandemic. The size of the workforce became much smaller than it was pre-pandemic. We also believe that many left the workforce, and for a variety of reasons. And we were wrong on that too. We really thought the workforce would grow. There was a shortage of truck drivers and warehouse workers prior to the pandemic, which the pandemic further exacerbated. The shortage of truck drivers before the pandemic was estimated at 61,000 drivers. Today, the estimated shortage is in excess of 80,000 drivers. The shortage of drivers was an issue then, and it'll be a much bigger issue now. And the prediction is it will be an issue in the future. We've seen some estimates that the shortage will double by the year 2020. And to give you an idea of the size of the driving force that is out there, the universe of truck drivers today is 1.53 million drivers. So you take, a 5% shortage, a 6-7% shortage, it's going to be significant out there. As a result, the cost of labor has increased significantly for everyone in the supply chain. With the supply of labor down, the competition for drivers heated up immensely. There was an extreme amount of pressure on the transportation and logistics side, and still is, and probably will continue to be for the foreseeable future. In order to attract and retain drivers, our company raised our wage rate 3 times in 2022 so far. In 2019, we gave all our employees free health care. And then we gave all our drivers and warehouse workers retention bonuses. If they stayed with us to the end of the year, they would get a bonus paid out on the 30th of January. And that did much to solidify the workforce. Then there were the supply chain issues. And the shortages of products we sell every day from our supply chain vendors was significant and still exists at a high degree today. Prior to the pandemic, and we measure our inbound fill rates from our vendors every week. We have a number of metrics that we utilize every week. Our inbound fill rate from our vendors was 99.2%. So for every 100 items that we would get in, or we would order, we'd get 99.2 in. Our inbound fill rates, right after the pandemic started, dropped down to about 55-60%. By December of 2020, it was up to 90%. And in 2021, we had a pretty good start, and then it dropped to 78 to 80%. And this year, it was probably in the 80% range, 82% range. And for the last 10 weeks, it has been running 90%, which is good news. We changed our inventory philosophies because we had many customers out there that depended on us for products. So we started loading up our inventories we used the popular inventory philosophy of JIT, just in time. And then we changed it to JIC, which is just in case. So we're over inventory, but those people need products. A restaurant who has got an event planned for Friday night and you make a delivery Thursday and the product isn't there, he's in trouble. And our business is all about customer service. As a rule today, most of the time, we don't know what we're going to receive from the vendor, and which is kind of unusual. There are many challenges for the vendor community out there. A lot of it has to do with raw materials. They have labor problems also. They've got priorities on certain lines that they're producing. And so anyway, most of the time, we don't know what we're not going to get until the truck unloads, or we might have a call from that vendor, which is a switch from the norm. And the timing of deliveries is probably not as great as it was pre-pandemic. Since the pandemic began, our vendors have eliminated over 900 items that we no longer have. And especially in the convenience line, that's where we really notice it. You know, between wages, worker shortages, the price of fuel, and the supply chain challenges, our costs have really skyrocketed. We believe, and have gone through our numbers and look at the inflation numbers. We look at our inbound freight rates, understanding that we get probably our products from growers, from shippers, from manufacturers. So they have freight into their establishments, and their freight costs have increased. We have got freight from their establishments to our warehouse, and then we've got charges, freight charges basically, that are built into our pricing to our customers. And we've been trying to calculate what percentage of the food inflation is relative to transportation and logistics. And we've got kind of a consensus between all of us.
We got a VIX, baby. We got the VIX. We're going to put it on over gold or something.
To 45% of the food inflation that we're feeling right now is because of logistics and transportation. It could be greater. It could be greater than that.
Oh my God, we're 31, dude. We are at highs from June 22nd.
We do a cost index report on our total product mix, and we do that every week. We started doing that about 25 years ago, and because obviously you've got to have growth, and you've got to have organic growth, and the difference between the growth you're realizing every week and inflation is basically organic growth. So our cost index report, and I've got numbers from I think since 2020. Indicate where we've been, the path we've been on. This last week, our inflation rate was probably the lowest it's been in, I'm going to guess, probably 4 or 5 months. It was down to 10.3%. But yet, compare that to what the inflation rate was the same week a year prior. Our total inflation from 2021 is probably 22-23%, in that range. So we're seeing some drop there along the line. We're also seeing some softness in the marketplace, which probably is indicative of why the inflation rate is lower. On the other side of the coin, we still have increases coming through.
Oh my God, future's getting wrecked.
We're still struggling with product shortages and labor. Product shortages are occurring for a variety of reasons. One of the big factors that's going to have an impact on inflation, probably yet this year and probably next year, is the drought we've been experiencing. I can tell you right now, and we hear this from the potato growers, we've seen the price on what we call baker's potatoes double in the last couple of weeks. And this last year, the potato growers in the Idaho area, which is really the prime country for growing the kind of potatoes a food service establishment likes to have,
Yeah,
they
dude.
knew they weren't going to get water. So instead of planting potatoes, they planted wheat. And so now there's going to be plenty of wheat that comes out of there, but the potatoes are going to be thin. There's an extreme drought that's hit in California. And California is a big producer of food that we consume. One of the products we're not going to have this year is going to be pears. I remember in 2012 when the drought hit, and we sell a large number of school districts, we imported fruit mix. We imported peaches from Israel. And Israel has, and that was probably the only place, some of those products were available. So we may be in that same boat here down the road. Tomatoes are a little bit on short supply. The other thing
Tom,
that's
seriously,
happening,
dude.
we're in the corn belt of the country, along with Iowa and Illinois, and we've had a lot of drought there. We're finally starting to get some rain. One of the things that happened last year, and you read about this and you heard about it, because of the war in Ukraine, the price of fertilizer, nitrogen, potash, and phosphorus just went off the charts. Nitrogen went from like $200 a ton up to $930. I know for a fact there were many farmers out there that were doing a balancing act. How much less of this can we use and still grow a crop? And what does that add to my costs? So my guess is going to be that we might find our production of maybe corn and soybeans maybe down a little bit this year. And depending on what happens next year and the experience factors they've got there may have an impact on whatever some of the commodity prices are. The beautiful part in our area of the country is that the cattle market is good, and we're starting to get a little bit of rain now. But if you look around the world, you go into South America, you go into China, you go into Europe, and it seems like every continent is having their share of drought. And so this might be a factor all in the future for food production, and especially the near future. That's just a personal opinion. Labor is still an issue. The driver pool is still far from being adequate. We have a driving force of 250 individuals, and we have positions we work to fill every week. There was a time during the pandemic we were short 20 and 30 drivers. We have one supervisor for every 10 drivers, and they drove all year. They drove vacation routes, time off for other drivers, and the like. Sorry about that. I forgot to turn that on.
Oh my God, dude. Shut
I
up.
find it.
All been there.
Sorry about that.
No problem.
Oh, you're excused, man.
Interesting ringtone.
Maybe to our
Dude, just short this
challenges about
dump
what your business
dumpster
outlook
fire,
for
man.
next
Dump it
year.
all.
I'm going to get into that.
Okay, great.
These people.
What other challenging issues might be facing and expecting to face?
Our business outlook for next year is good. I wouldn't say it's great. First off, we sell commodities. Our company was founded in 1934, and that was during tough times. It was founded in 1934, and the products we sell are really, in a sense, recession-proof. They're people have got to eat, so we're looking for probably a fairly decent year. On the other side of the coin, there's going to be casualties in the marketplace, and we could have some short-term challenges out there. And the way we're dealing with that is interesting. We're working programs right now to keep our customers profitable, and we're reaching out there because because, I mean, they're the lifeblood of the organization. And I think during the recession in the 80s, there were a lot of folks that didn't have a lifeline. Communication wasn't great. So we're reaching out to those folks now. We need to see them through this thing. And it's not a matter of extending them more credit. It's not a matter of giving them some type of stimulus along the line. It's helping them better manage their business, make it more profitable. So that's going to be.
It's all right. NASDAQ futures getting destroyed. Session lows down 2.7%, falling. This guy's stupid mouth.
If there's I think there's I can't tell you exactly, there's over 2 billion trucks in this country. We have not been able to upgrade our rolling stock, stock for probably 2 years. We have 250 tractors, we have 400 trailers that we need to make the deliveries. We haven't been able to acquire a new tractor since November of 2019. We typically replace 10% of our fleet every year. The last tractors that we purchased in November of 2019 cost $106,000, and it's pretty much a standard product that we buy. Got 5 coming next week. They're $165,000 a tractor, 40% increase. Plus, we've got to pick slots now. We're guaranteed kind of halfway of having probably 20 tractors. We really need 50. We're guaranteed to have 20 tractors in 2023. So we're gonna spend probably 5, 6, 7 years getting things caught up in our fleet. The cost of putting trucks on the road today is very significant. It's gone up right around $80,000. So that's going to have an impact on transportation total. And when you look at the number of trucks in the country, and the options aren't great. We had a number of trucks sit this last year for 7, 8 days because we didn't have microchips. They were 2017, 18 models. The parts availability, tires is one big thing. On trailers, insulation, we had trailers we ordered 2 years ago that we finally got in the first part of this year. Those went up 40%. So 40% sounds like probably an average cost increase that we're going to see with rolling stock for any operation out there. So I think I'm getting down to the end.
Tell me, how does that inflation and cost for these necessary replacement items, how does that impact your outlook for going forward, or changes to how you prioritize expenses in other areas?
One thing about it, you got to have the cash flow to do it, and you've got to have. So that will be the challenge in developing a plan, a business plan, which we will do. I think in our company is sound and solid. I don't see a problem there. But I do look at other companies in the industry, and I think they will have some challenges there along that line. And there's some options out there that they can certainly use. But it's going to be a challenge. We spend more money today on just maintenance. A vehicle gets so old and you have a problem. The other thing we need to do that's going to be important is we need to get the manufacturing of a lot of those component parts back here in this country. And I could give you a list of things that we have to source outside of our country that put us really in somewhat of a predicament when it comes to keeping your trucks on the road.
Thank you. We'll probably follow up with you to learn a little bit more about that. But I'd like to ask my colleagues if they have a question.
Yeah, just a couple, one narrow, one broad. The first question is, are you able to pass these costs along? You obviously have been hit by, costs right across the board. And the second thing is really, do you feel like we're getting through this process? That there was enormous disruption to your business and many others, and all these cost increases and shortages and everything. Do you feel like And I guess there's not that much progress with the drivers, but do you feel like we're getting back to a better place with the suppliers and the customers yet? Or is there a sense of progress?
I think there is a sense of progress. We're making the move, and I think the moves you make are extremely important. And I think that'll get us in the in the right direction. And I applaud you for it. I do think that we're moving maybe a little faster than what I thought in terms of the economy and everything. So no, I'm confident we're going to get there. We might be, the only thing I'm not confident in, I remember when the pandemic hit us, they said, in 30, 45, or 60 days, things will be back to normal. I think what we're encountering right now is going to take a period of normalcy. It's going to be probably 2, 3 years off, 4 years off, maybe. We've got to get caught up. It's not going to happen overnight.
And on costs, you've been able to pass those right along since
Yeah,
these are-
we have. And the dollars we work with are large enough and the customers really don't have a choice. They don't have a choice. We can't lock in old pricing unless they've got contracts somewhere out there. We can't lock that in. And so they end up having to pay it. They're so voluminous right now.
All right, just for a second. This is a fertilizer stock NTR. So I figured, hey man, there might be movement based on this boomer talking about fertilizer. No, it's down like everything. It's down 6% right now. It gapped down below the 200-day moving average, and soon we'll be testing a demand line that goes back to the COVID crash. A lower high was put in. That's not, that's distribution, man. Distribution at lower highs. So,
It's still floating out there.
yeah, just looking at this, it's a long way down if,
It's going to be the
demand line breaks. So we'll go back to them.
And we've, anyone that's in production, if they're in sales, if they're in manufacturing, whatever the case is, their salaries have kept up, drivers and everything. But we've got a layer of people
Another one almost identical.
haven't had a lot of
Almost identical.
haven't had a
Mosaic
lot of opportunities for
fertilizer.
increases. In fact, right now, one of the things we are doing is taking every one that hasn't had an increase and figure out how we can give them one, and how we can give them one that's substantial enough. So that's going to be a challenge, probably for everyone down the road.
Thank you very much, Tom. We appreciate your perspectives, and we'll move on then to our second
Thank you.
panelist, Chidi Kumar. Chidi is the chef and owner of Garland, a restaurant and performing arts space in Raleigh, North
Oh
Carolina.
my God.
Chidi's a self-taught cook who studied recipes while pursuing a career as a guitarist in several
Dude,
rock
no way,
bands.
man.
She was a semifinalist for the James Beard Awards Best Chef in the Southeast from 2017 to 2019 and was a finalist for the award in each of the participated in our board Fed Listens event last year, and where she shared compelling stories about the challenges that she faced running a restaurant business during the pandemic and in the early recovery period. Chidi, thanks so much for being here with us in person this year so we could actually meet you face to face so that you can share also your perspectives on how things have changed.
Dude,
since
dump
last
this
year.
market, man.
So our first
Oh my-
question for you is about how your business has changed actually since we spoke last year. How does customer demand now compare to what it looked like before the
Tell us about
pandemic?
your emotions
And
and
how
your
does the change in dining
feelings.
patterns
Please,
that
your
you think
anecdotal information. Oh my
Thank you,
God,
Madam
your
Chairman,
evidence.
And thank you for having me back. It's a pleasure to be here. So our restaurant, music venue, bar complex is one building that we have been paying rent on since 2010. And we
Do we really?
at the end of August.
We'd rather listen to her than me look at charts.
There were many factors leading to that decision, and most of them are really, I want to say at the outset that I'm a restaurant owner, I'm a chef, and we're working on a new project. I am speaking from my perspective as an independent restaurant owner. Restaurants are ubiquitous. You can eat at a fast food chain, you can eat at a fine dining chain that's in airports and hotels all over the country. their perspective is going to be very different than mine. And I almost wish that we had a different name for our sector of the industry, because our challenges are unique, and the way we approach those challenges are very different, because the math is very different.
What is the purpose of this council?
Bro.
So many factors.
I thought it was going to be like Jerome Powell speaking about something, but now I get it.
You know, dining patterns.
Now I
change
get it.
our restaurant.
Let's just mute her for, you know, when like, you know, let's hold on a sec. Let's just have her on mute in the background. She can be there, okay, over the tip jar. And if Jerome Powell starts speaking, boom, I'm muting it. I'm muting the music, going straight to him. Let's do it. But my God, come on, dude. What a joke. I mean, how do I get an invite to this thing? Like let me talk at this thing. If she can talk, let me do it, okay? Hey, I'm just a live streamer. I like looking at charts and drawing lines. Very strong, very brave. My experience during the pandemic. So let's just real quick look at Ethereum and Bitcoin. I mean, crypto's holding up very well. Volatility index right now, as I'm speaking to you, is at its highest high since June 22nd. The US dollar has just hit fresh 20+ year highs, which I'm assuming the euro is hitting fresh lows. Every other currency pair hitting fresh lows right now as I'm speaking to you. Great Britain pound, lowest level since 1985.
Taco.
What's up, Mighty Mushroom? Thanks for the tacos, dude. Yeah, you still have market activity. I mean, the quad screen. Let me take everything away from her, but so we can still see. I mean, this is extremely valuable quad screen we've got going on that shows the market activity. As I'm trying to just look at other assets you might care about. I mean, Ethereum it's like in between two levels right now. You know, the target's around $1,000, $1,020. The bat, you know, it broke the bat action magnet move. Pattern completion zone of the bullish bat takes you there. High probability that's happening in time if you're patient. We might see a dump this weekend on crypto. But yeah, right as I'm speaking, holy crap, Bitcoin and crypto, so much better than any currency pair outside of the US dollar. I mean, I would like, let's like, this has to, like, I can't even believe this is happening where I'm looking at Bitcoin and the Great Britain pound, and it's like, oh, it's just barely, it's not doing anything. It looks just like the US dollar pair, and it's like, okay. Something's happening. I mean, we're seeing some very historical moments right now on the world stage, right? The financial world stage. S&P is at fresh lows. Volatility index again, fresh highs. Yeah, as I'm speaking to you, this is happening. This has been going on pretty much since the stream. I mean, before the stream started, but it's just been going, man. Let's look at some of these pairings to US dollar, like the Great Britain pound, so you can see how bad. This is not an S coin. This is the Great Britain pound. We'll soon be at parity. We'll soon be at 1-to-1. Like 1 US dollar equals 1 pound for sure. That's coming. I feel extremely confident. I mean, like, how is it not happening? How will it not happen? Clearly, the market is telling you the new PM, their policy, her spending spree, her first thing in office to just spend more money. We got a debt crisis. We got an inflation crisis. Just print more money into that. That's throwing gasoline on the fire, and the free market is dictating what they think about it. And you're looking at it. I feel like, dude, again, haha, cool, we're short on a lot of stuff on equities, but this is different, man. This hits different and doesn't make me feel good. Like, I hate the currency pairs are collapsing around the world. I mean, like, hey, I love cash, right? Well, I'm American, but like, if you're just Joe Schmo over in England or Scotland, or if you're German, my God, you're so screwed. If you're Australian, you're screwed. If you're Taiwanese, you're screwed. Oh my God, even if you're Chinese, you're royally screwed. You're dictatorially screwed. There you go, right? Appropriate. VIX still at its highest of the day. Right there. Oh my God. No one told me that the music was too loud. What's wrong with y'all? Right? It's still too loud, yeah? See, that's better. Again, we got this lady chef that we're not giving her a platform on this stream. I mean, she'll be there just so you can see it, but she's just muted until we get someone else speaking, preferably Jerome Powell. That's why I went live, really, for him to see how it would how the markets would react. And clearly, I think the free market is just as disappointed as all of us with this stupid panel. Short it is what they're saying. Now we can, we can look at the Euro too, which is also destroyed in utter shatter or shambles. Look at this. Hey, I would say this: the traditional technical analysis has been respected, as your forex pair had a support and it has been reached. And if you break this chat, oh man, we haven't even really talked about what happens if the euro breaks this support, which is very real. It's real level, 96.7, 96.9. We've been eyeballing this since we broke $1, right? You're talking about 90 cents. It's a straight line up, and that's the only data you have. So it could definitely be a straight line down based on the fundamentals, the policies of these stupid bureaucrats. They're not changing anything. They're not doing it until a change happens. Why would this stop, man? It won't stop. Nothing's going to stop its course until there's actual change from these governments. Governments aren't doing anything. So, hello? We have a beautiful downtrend too. You want to see with the downtrend? I mean, if you want to get oversold in the downtrend, look at this beautiful channel. It's magnificent. All right, look, dude, oversold's like 94.8. All right, there's your demand line that's been very well respected. That means you're breaking support, and a soy boy demand line with nothing backing it up is very bad. I can't even. Oh my God, it doesn't even show the data on the 4 hour. Okay, so I would just say buckle up, but that's something I've already been saying and over and over and over again. Volatility index has just hit its session highs. The S&P 500 has just hit fresh lows, multi-month lows. 36.52.60. Dump this trash. Dump this trash. People in charge. Okay. Dump it. Staying on the quad screen, we got a market meltdown on our hands. If you're enjoying the coverage of this market meltdown, hit that like button, that bell, that sub. Really appreciate you all being here. Let's just look at the S&P 500 so you can see the meltdown. This is a meltdown, right? You are going virtually straight down, no buying, buying strike. You have filled the gap on the last 4 hour candle, official gap fill. So Jesus chimes for that. The June 17th gap, right? Filled, and now you're just rolling over. Rolling over. And I have an alert set up when we hit the lowest lows since, you can't even dream it, December 2020. It's coming. It might be today. 32 on the VIX now. Fresh highs just half a second ago. Why is are the decibel levels good on the music? Is it too loud? Because dude, it's saying it's too loud. Hold on, I'm trying, man. My mixer gets screwed up when I have to max out volume for them. Okay, that should be probably better. It's probably a little quiet now, but still. Now it's perfect, probably, Nathan, right? So I'll just say, man, how can you be surprised? I just don't know how you can be surprised. If you're a part of this community, right? If you respect technical analysis, I don't know how you can be surprised. And things are only going to get worse because they're not going to do anything. No one's changing course, so everything happening on a chart will continue its path, including the DXY. 115 is an 88% retrace from its 2000 highs, but there's no formal resistance looking left at that level, so it's not as strong. Again, 120 is your 119 to 120 is your 2000 peak. You got to wonder if we're going to get there. I mean, I think it's all on the VIX. It's all about the volatility index. Let's look at this on the bigger screen, singular screen, if you will. This right here is what's going to make everything correlate to 1. They don't get this under control, the bots are going to freak out, and there's going to be acceleration of the sell-off. And I'm talking Bitcoin won't be able to hold up. If this thing keeps going, Bitcoin will eventually have to capitulate, like everything else. Like gold is dumping, currency pairs, individual equities, index funds. The VIX is up 17% today. No surprise, just constant accumulation, above 200 moving averages. Even the daily, I believe. Yeah, you were above the 200-day moving average after all this oh my God, dude, it's like, we're going, man. Again, highest level since June. But it looks like it's very possible if this keeps up, you're going to be taking out those June highs. The highs of the year, though, is in January at 38.98. I think that's when they're like, oh, man, we got to get this under control. They have no control. Fresh lows. Every time I'm speaking to you, chat, fresh lows in the S&P, fresh highs on the VIX. Not quite on the DXY. Okay, it's close, though, right? Very, very close. It is kind of beautiful, though, how Bitcoin is holding up so well relative to mostly everything. Everything, man. And really appreciate the nearly 1,000 people tuned in. I know you're just as intrigued by these market moves as me. And I really appreciate y'all here, because you could be anywhere. You could be listening to her discuss her feelings about how tough it was during the pandemic. Yeah, the government. Yeah, you can thank the government for that. All the weak leaders of the West followed the communist Chinese plan, right? They locked down. So, hey, great idea. Let's just do what the communist Chinese do, where the virus came from. Let's do that, man. And now look where we are.
Ooze. Happy Friday, chat. Is it too early for clinking beer mugs?
Too early for, yeah, I mean, maybe a little bit, dude. I haven't drank in like 2 weeks. Thanks, dude. Yeah, maybe a little early. Yeah, I don't know, man. I mean, if the jar fills up, maybe, okay? But, dude, it's just like, welcome to the bear market, okay? You're gonna have me sober more often, okay? So, right, because I like drinking for celebration, not satisfied. But I mean, I'm pretty happy because the TA is being respected. A lot of us are making money. I mean, because just everything just telegraphed lower prices. Should be a bread stream. Well, it was pretty much a potato stream for the first half, you know, the old man Nebraska talking. So the VIX is the centerpiece of today. I don't know. I mean, how many? There's like multiple centerpieces, I guess, right? It's the centerpiece, and then you have the secondary centerpieces, the currency pairs, and then we could just look at some individual stocks. You know, I mean, oh, it's ugly, man. And I like look at this. You know, this is Suncor Energy. All right, an oil company. It was bearishly consolidating. It broke its bear flag a couple days ago. Bearish engulfing, below the 200 moving average. Bye-bye energy. You gotta love this, man, because this stuff was setting up. This wasn't even, I mean, this one was good, right? Like, man, bear flag, dude. But it wasn't a harmonic, right? It wasn't hitting 886s like some of the other ones. Like, look at this. This one, ConocoPhillips, the Jesus, man. Oh my God. Like, you can't make this up, chat. Can we please get Jesus chimes? For ConocoPhillips, TA being respected uberly.
Shout out, Mitch, dude. I love you, TA respected.
What's up, Mary? Thanks for the 5 super chat, man. This is a trade setup, and I was like, hey, man, just yesterday, I'm like, hey, man, I like the way it's looking right now. Everything's good, but I'm not gonna rest easy till we get some more movement down. And here it is, the gap down. You're down 9%, dude. Imagine just having like one put or some shorts on this just because look at it. If that didn't make sense for a short or a put, or taking profit, getting the F out. Nothing would make sense to you if you cared about charts. Nothing.
Let's go Hawks. Happy Friday, Mitch. Football.
What's up, Tommy? Yeah, man. At least we got that to look forward to, too. Yeah. Unfortunately, Bama's playing Vandy, so it's going to be another slaughter. But, yeah, I know we're coming to Fayetteville this year. That's going to be a doozy of a game. I know Arkansas is going to be very competitive in it, just like y'all were competitive last year. Yeah, man. I mean, it's like without us having a deep threat, I mean, if we don't play right, if we play like we played against Texas, I mean, Arkansas certainly has a chance of beating Bama. Anyway, thanks, Tommy. Suga's up, man. Suga's up 7% on the day. I can't believe it, dude. Oh, my God. So ExxonMobil was another one that was just primed. Do you remember the bearish Gartley chat? Pretty much the type 2 on the lower high. And there you are, down 5.77%. Just the gap down. And it's like, I don't know, man. I'm just... Look where you were. It wasn't just the Gartley. It was where the Gartley developed, chat. Look at the level, man. This, from 2007 to 8. That's where the Gartley developed. You were at the top. You ran up nonstop for like 2 years. And then you just happened to hit this inflection point where the massive cycle reversed. Maybe I shouldn't ignore that. Maybe that's like literally a good spot where a massive reversal could occur, and it's begun. Certainly begun. Just like commodities, right? Hitting these levels from '08, and then what they do, they reversed at those levels, man. After massive run. Let's take a look at another one, another energy stock that was just like, you got to push it, man. You got to push it. The Hess Corporation. Perfect. Let's see. More Jesus chimes, chat. More Jesus. This thing's down almost 10% today. It was perfect. It wasn't just the 886. It wasn't just the type 2 return. It wasn't just the bearish divergence. It was the fact that there was this well-established uptrend with the supply line. You up-thrusted through the supply line, and you can clearly see where the harmonic completed at that supply line. It's chart art, dude. It's chart art. You're falling below the 200-day moving average again. I mean, nothing even makes sense until $91 for a certain type of reaction here, okay? The Jesus. VIX still highly elevated. S&P 500 near its session lows. Bitcoin hanging in there like a champ, dude. Beautiful. So, but there's more. Let's look at FedEx. Let's just check in on FedEx. Remember what happened? Okay, a breakaway gap, a certain breakaway gap. That means this gap won't fill anytime soon. You're going to be older, a lot older by the time this gap fills. Okay, you had a nice you were downtrending, man, and then destroyed. Now, yeah, I get it. Hey, man, you're probably going to see 121 in time. Are you ready for that? 121, a peak from 2006, 2016 Valley. Clearly, that's where there was price action correlation in the COVID crash. That's where you're headed. So FedEx, where it is right now, there's still, after all this carnage, there's still another 18% downside on FedEx. Let me show you something that is insane right now. And of course, today it's probably really going. But who's the rival to FedEx? UPS. Look at this. Chat, look at this. It's just really more like,
oh, would you look at this?
So I did all my work downstairs, but let me show you what I had. This is old, outdated stuff. Let me just clean it up so I can redraw it for you. I had a discussion. I was on the phone with Scott Carney for a good hour yesterday talking about these markets and what's coming. And it's gorgeous, man. Like a beautiful momentum shifting structure. really is a sight to behold. And let me show you here where it's like you're headed. You are legit headed to 154.75. But when you break that, which seems very likely in time, when you break that, it just seems like you'll be seeing 120 after that. But just imagine, right, how large this pattern is after such a nice run. An 88% retrace on this, a full reset in an uptrend would take you down to $98. If it goes to an 886 in time, it could take months, if not a year. We're talking like 40% more downside on UPS, United Parcel Service, chat. Yes, head and shoulders out the yin yang. So KMI. Dude, you cannot make this up. You can't. It was truly a bearish Gartley. It didn't just hit the pattern completion zone. It didn't just have bearish divergence on the daily. It's where the pattern completed, and this is what I try to teach because it's not about the one, it is about the many. Look at this high from 2021. Look at these highs from 2016. Do you understand?
Can you look at Meta? Is there a breakdown of ascending broadening wedge? How is the measured move measured?
So Rethink Finance. We can look at Facebook. Don't call it Meta. Call it Facebook. Don't try to church it up, okay? That's what he did. Zuckerberg tried to church up Facebook because it's a dying platform. We all know it. He knows it. And he tried to get in on the metaverse hype. And it failed. It blew up in his face. He got caught up in the euphoria. The composite operator made Zuckerberg think that metaverse was ready. And so he changed the effing name of his company. That's like, that literally happened. That's composite, man. Not only going to make people FOMO at the top, going to make multi-billionaires, one of the richest guys in the world, change his company name. And then make that stupid commercial. Remember him in the metaverse? Like a moron. Oh my God, dude. These people. This is what happens. Wealth concentrates. And then from their first idea played out, they ruled the world. And then they got no more ideas. They got nothing else. We're gonna buy the rights to some of Lord of the Rings, and we're gonna run it into the ground with trash writing and woke agenda. Yes, we're gonna do that. Desecrate Tolkien's work. That's all that happened. They did that, certainly. VIX at the highest level. 32.08 chat. DXY nearing fresh 20-year highs. Of course, the S&P has just been flirting with fresh lows. Oh yeah, the Rings of Power, it's the worst thing in television history. It's the biggest flop in human history for television. 100%. It's never gonna be official because the people that have written this, that are behind it, are all on the same team. They treat it like a sports team. They will not be impartial. They will only talk about how brave everyone is. Oh my God, dude, it's the worst thing I've ever. No, dude, I can't even watch it. I've read the books. I've read Silmarillion. I know everything about the story of all this with Numenor and stuff. Second age, first age, third age, I don't care. And they have done the worst thing I've ever seen. Oh, what's this guy doing?
Right, so I'm not sure if that's the case for you guys, but in many cases, folks are saying,
what's this guy
"Hey,
talking
I'm
about,
not
chat?"
in the office for a week, and what we used to call leisure travel, right? You know, I had a conference in Las Vegas. I'm going to stay there for a couple days and stay over for the weekend and all that. Is actually something broader, right? That we start to see some return to a new customer dynamic where they want to have a larger room and stay in a place that they can, you know, work during the day and, you know, connected to the internet and all that good stuff, but then at night they can do all the things they wouldn't have been able to do otherwise. Doesn't impact all customer segments. Obviously, those with families still have to follow regular school schedules. Hybrid meetings are interesting, right? I understand you guys were doing this in a remote fashion, right? We need folks to get together like this. We're not sure what the future of a meeting like this, where half the table's over television and half is in the room. That's an emerging potential trend that we're going to all have to figure out, right? Everybody's been on conference calls where it's extremely uncomfortable, where you're the one who's not in the room and everybody else is. So we've got to figure that out, but that will lead to some sort of new normal. And then the last thing I'll just call out on the sort of new normal is emphasis on digital tools, right? So for us, that's, folks were trying to skip the front desk, right? That there's a little bit of a different model in how you engage with people in a COVID type world, which means you want your key on your phone, whether you're flying or you're in a hotel room. So we've had a heavy emphasis on that in our business, but we're seeing that as sort of a change in customer dynamics, which
Margaret hates this guy.
could
Wow.
shift sort of the labor model where hopefully team members are able to focus more on service as opposed to transactions. Transactions can be handled more digitally. And then just touching on labor, similarly as Judy said, our industry's been hit dramatically from a labor perspective. We're still 400,000 jobs less than where we were from an accommodations sector. We see it in all of our hotels. And when you think a demand environment where on the weekends you're busy and during the week you're not, right? That's a difficult thing to labor schedule around, right? And you don't get the consistency of scheduling that our team members demand and expect. We're also seeing, the inflation of wages in our industry broadly double what is the broader wage inflation. So typically in the 12+% range, we've seen across sectors and across regions in the U.S. So we're seeing some shifts in dynamics from that perspective.
I know Governor Cook has a question.
Yeah, please.
The data thank you for the presentation. The data that you're presenting are for the U.S. or are they global?
U.S.
Okay.
Yeah, although we see similar trends. I mean, it's such that it interests you. We do see similar trends outside the U.S. One interesting dynamic is, take Europe as an example. It's so much more dependent on
Session
cross-border
highs,
travel.
VIX,
Right? And so obviously
session
that was more
lows,
depressed
SPX,
when cross-border
20
travel
plus
was
year
more
highs, the U.S.
Here we
dollar,
didn't have as much of that.
20 plus
But
year
major
lows
US
on
cities,
multiple
right, the lack of
equity or
international
multiple
travel,
currency
New York
pairs.
and San
Get
Francisco
backed.
certainly played an impact on demand.
And taste preferences?
I'm sorry?
Taste preferences, same kind of thing?
Yes.
Sort of,
Yeah, generally we see that. I mean, focus on the U.S. from a customer perspective, but yeah, we see those sort of trends. I would say obviously there are countries where it is quite different. China obviously is a different sort of customer environment. But
I don't know. Y'all asked for this. Y'all were like, turn him on.
Follow
Let's
up on
listen to
your,
him.
Question. So, if you look at where employment is actually down relative to pre-pandemic, 1.4 million in in-person services, it's heavily in leisure and hospitality in your sector. Is that because people aren't coming back to that sector, or is it because your demand is down and so you're not demanding the same level of employees?
It's undoubtedly a mixture of all things, right? And as somebody who grew up working in hotels and is passionate about that sort of service economy that we had, it's in some ways can be less enticing of a job in a COVID type world, right? Essentially they were essential workers having to be face to face in ways that us in corporate office world we're not necessarily having to do. So I think there's an element of that, which is we need sort of a mind shift back to where we were and the value in face-to-face experiences. When I think about what we're trying to do from an employment perspective, it's hard to get people to come back to work. So I think it's a little less of the our demand isn't requiring as many folks coming back. I mean, right now, as I said, we're close to 5% down from a demand perspective, so not massively for that level of job displacement.
So
Thank
can
you.
I ask just a related question? So recently I was talking to a large firm in leisure hospitality, and they were talking related to what Governor Brainerd just said, that their turnover rates, job turnover rates, had doubled than pre-pandemic, that even when you can get workers, you can't keep them. Is that something you're seeing in all these
I'm
areas?
sure we would see something very similar. We're all competing for the same subset of folks, that it's a smaller pie that we're all competing for, right? So you see certain places where folks are putting out big bonuses to try to convince people to come their direction. And then we have to all, go back and forth. And so, the pie of workers in our industry broadly is just not wide enough.
So regardless of what we do for demand, you're still going to have demand for labor.
Yeah, I think, that's the case.
Well, just thank you so much and congratulations. We hope you're getting some sleep.
Thank
appreciate you being here with us. Our fourth panelist is Kara Walton. She's a director at Harbor Results, which is based in Southfield, Michigan. Kara leads the company's manufacturing intelligence business, which collects and analyzes millions of data points from thousands of manufacturing companies in North America. Harbor Results collects data from more than 600 privately held small and medium-sized manufacturers.
Power Hour has begun, chat.
Kara and the team at Harbor Results utilize these data and information to help small to medium-sized manufacturers improve their competitiveness in the marketplace. Kara also studies economic, business, trade, and tariff trends impacting the manufacturing industry, and she consults with clients on their business impacts. So Kara, thank you so much for being with us today. Can you help us understand what your most pressing concerns are for the small and medium-sized manufacturing businesses that you work with?
Yeah, absolutely. First off, thank you, everyone. It's an honor to be here. I really do appreciate it. As you said, right, we work with the small and medium-sized manufacturing base. We're also a small business. We have about 15 people total on staff, so we're quite small. But beyond working with those small to medium-sized individuals, generally they're all less than $500 million. Some of them are
Nice
$5
nose
million
ring, oh my
companies
God.
a year, and some are 700, right? But generally speaking, they're under that range. We did the math in our organization to give all of you a sense. It's about $30 billion in an annual year. That was incorrect. And it's $30 billion annually in terms of total output that they're putting out in the market. So to give you a sense of what they're looking at, they're privately held, they're not consumer facing, so they're supplying to a tier one or to an automaker or an appliance maker, and they're generally not unionized. So these are they're small and they're family owned, right? Sometimes we have second and third generation leaders. Our team took some time to kind of come up with an answer to this question, and we broke it into two core facets. Their biggest challenge from our perspective is labor, and we'll talk about that one a little bit. And then their second biggest challenge is the ability to make money. So if I could start with the labor piece, frankly, there are many facets to it, all of which I cannot answer here, or else we might be here for a while, as I'm sure similar to you guys. But I'll do my best to give you a high-level explanation. So the number one core challenge that our people have is that they can't find people, number one, and more specifically, they can't keep them. So in some cases, they are absolutely getting people into the door, and then they're not sticking around. This goes far beyond production workers. So I absolutely do have clients who have challenges where, frankly, sometimes Starbucks, or we're in Michigan, so the Tim Hortons or something like that will say, we'll give you a $1,000 signing bonus. We absolutely have companies who are losing employees to that, but it's also a skilled labor challenge. So we're lacking skilled labor, we're lacking people willing to even go into apprenticeship programs, and we're lacking office staff. One of the things that you guys talked about was that you don't have the ability to do work from home, nor do these people. At the end of the day, they have to make pieces and parts, so they don't have that capability similar to a tech world either. I want to be clear about one thing as we kind of talk about the labor challenge. At our core as a business, we focus on making sure that the only answer isn't adding people. We want our businesses to be efficient and to be productive, but they truly can't even find enough people to be efficient today, which is the big problem. Anecdotally, I was talking to a plastics processor this morning that hired 14 people last week. 3 of them showed up this past Monday. 1 of them left at lunch. So, this is not the only person who says this, right? I hear these stories, and our team hears these stories all the time. So one of the things that we really see, right, is despite all of these businesses offering really high-paying jobs and offering career development tracks and they're paying really big bills to train these people, right? They say, hey, come in with no experience. I'll make you a tool and die maker. I'll make you a process tech or whatever it is. They're not able to even find the people willing to go in to take that level of education. And what we see happening when we look at the data is that a lot of our manufacturing clients stopped hiring during the Great Recession because, frankly, you guys know better than I do, their businesses were quite challenged. So they stopped hiring at that point in time when a lot of millennials were graduating out of college. And frankly, that gap is really rearing its head today. Not only do we have an average age of an owner, right? The average age of an owner is over 60. We have an average aging workforce overall. We don't have succession plans, not for key leaders or for other areas of the business, right? So if I have a production manager who's in his late 60s and says, hey, I want to retire in the next 4 years, there's no one there that's even considering being the next person to be that production manager. You lose a production manager, your facility doesn't
Remember,
count.
we are in Power Hour.
So beyond that, right, what we're really watching, and our bottom line is that it's costing these guys a lot of money. And what they're starting to tell us and what the data is starting to show us is they're choosing not to grow their businesses, which is a big challenge, right? So they're saying, hey, I'm not going to take on more revenue because I don't have the people to do the work. Or in some cases, they're even saying, I'm going to shrink my business. which brings me to my second point, their other biggest challenge, which is they can't make money at the rate that they used to be able to. You said there's a lot of compounding issues and everything. There's a lot of compounding issues in this one as well. But some of the core pieces of it that we're seeing is that despite these businesses increasing their efficiency levels, so they're absolutely doing better from an efficiency and throughput perspective, they're not making more money. So when we look at their actual profit margins, they're not going up. They're frankly going down quite substantially. It's due to a lot of different reasons. One of them is the labor piece, which we talked about, so I won't go into too much more detail there. The other piece is this overall cost of doing business. So it's everything from energy prices, it's transportation costs. The rail strike was a really big, or potential rail strike, was a very big challenge to these individuals. Healthcare costs, and everything from temp agency upcharges, right? So when somebody's trying to get temp labor in the door, it's 30 to 40% higher than it used to be. Interest rates on loans is a big one. Most of these companies do not have cash. They're privately held, but they all use lines of credit. So that's really impacting them as well. The other piece that's preventing them from being able to make money, at least consistently, is they had a lot of PPP or ERC funding, just depending on the type of business. Most of them did get that because they are privately held and small. Some of them used it better than others, right? Some of them used it as a lifeline and frankly just delayed some of the challenges that they were feeling before COVID even took its toll. And now that that money's dried up, they're feeling those same challenges again. My final piece on kind of their challenges from a financial perspective, which is potentially the most challenging to quantify, but I did my best to put it into numbers, is this increased chaos that they've felt over the last 24 months is really preventing them from being able to make money. So the best way I can kind of articulate that to you is that most of the customers and companies that I work with don't know their customer demand. They don't know the schedule on their shop floor. They frankly don't even know who's going to show up to work in a given week, and in some cases in a given day. I mean, there were periods of time in 2020 where we would talk with customers who would say, I got into work today and 8 things changed between 7 and 8 a.m., right? So they don't know how to do this. At the end of the day, what that's doing is that's driving up massive amounts of transactional waste. It costs a lot of money to hire someone, even if they never show up. It still costs money to get them and process them and give them healthcare and all of that. Additionally, it's tying up a lot of money in inventory. So we've seen massive shifts in inventory right now. And the final thing is that it's really costing them way more cash than it ever did before. So their ability to have any flexibility in terms of how they spend their money and how they make money is gone. And at the end of the day, right, this is a massive group of people. They're not all the same, but the viability of many of these businesses long-term is really concerning to us.
Those are very difficult challenges that you're dealing with. Could you give us some perspective on how supply chain issues are continuing to impact your business?
Yeah, absolutely. So I will flip to the final page of the notes. So from more of a supply chain perspective, we are based in Southfield in Detroit, Michigan. So we do work a lot in the automotive space, but we also work in others. I personally came out of the appliance arena, so we work across most of them. A lot of the challenges today seem to be around semiconductors. That's a big thing that seems to get picked up a lot in the press. It is absolutely an issue. I'm not going to belittle it. But there are a lot more problems than just semiconductors. To speak on the semiconductor one just for a second, some of the core challenges that we're seeing is not only does automotive need semiconductors, but your refrigerator needs semiconductors. There was like a new PlayStation that came out last year, and that needs semiconductors. A lot of people talked about it. PlayStation and Xbox are confusing to me, but either way. So that was demanding microchips, all of these different things. So automotive companies can get them, which means that this whole demand problem that our customers are facing, they have no way to plan when they're going to get chips in order to put them into the parts that they're ultimately supplying. The other piece on the semiconductors, just real quick, is that when you think about an electric vehicle coming into play, they require at least 30% more, sometimes even more than that, than an internal combustion engine does. So if we adopt more electric vehicles, we're demanding more semiconductors than we ever have before. But beyond the semiconductor challenges, probably some of the more concerning things to me and maybe less easier to solve challenges from a supply chain perspective are centered around things like transportation and freight, which all of you talked about in different arenas. But a lot of that applies to things much more than automotive as well, right? So you talked about the agriculture business. We work with companies who can't get washers and bolts to make trailers to hitch on the back of their F-150s to get whatever they need to get, wherever they need to get it, right? The other big supply chain challenge that we don't really see a light at the end of the tunnel for is natural disasters. You talked about it from an agriculture perspective. There's a lot of impact to that on the resin and steel markets as well. The resin market specifically, there are certain types of resin that ultimately allow you to make your dashboard or make the some of the plastic that we probably have in this room right now. The capability for them to get that resin even before the most recent round of natural disasters occurred, some of the major freezes that happened last year, it was already in force majeure. So these companies were already taking the time to go, we need this because it's a crisis, and then it got worse, right? And that had nothing to do with any of the port challenges or any of the difficulty getting a bolt out of China or somewhere else. So that was one of the big pieces on the supply chain front. I guess to bottom line it for you guys, at least if I could, in terms of what we're seeing from the supply chain piece of it, automotive specifically historically has been a 17 million a year sales volume in the US. This year we're forecasted to do about 14 million units. If you look at the OEMs, which are publicly traded companies, unlike my customers, they're making money and they're doing quite well. They have their challenges, as do all businesses. They don't necessarily have a reason to go back up to 17 million units based off what we see today. The reason why I bring that up is because this means that we have a lot of people who are supplying to them who are dealing with a much higher mix because everyone wants something different in their car today or different in their appliance, and we're dealing with a much lower volume. So at the end of the day, what that does is that increases the complexity for everybody that we work with. And then within that, what that does is that makes them really challenged to manage all of the supply chain pieces that we talked about. And at the end of the day, they're focused on this week, am I going to run out of cash or am I going to shut down my supplier's line, right? So, I mean, these are the kinds of decisions that these companies are facing. So I don't know if that fully answers it, but that's where we're at.
Fantastic. I'd like to open it for anyone who.
Yeah, so I'm just curious if these firms, it sounds like some of them have more demand than they can handle. So if there's a downturn in the economy, how are they going to manage it?
Yeah, so they absolutely have more demand that they can handle. From an inventory perspective, we're still well below it. We saw demand on average for them go up nearly 30% between 2020 and 2021. It's plateaued a little bit, but it's still relatively high. In terms of that demand lowering, I frankly think some of them would be, I'm not going to say pleased, but would be relieved by that. Because the intention of that demand lowering would mean, hey, maybe a couple of my 20, 30, 40 open positions I no longer need to hire for. Maybe I can take a breath to actually manage my business and focus on continuous improvement. Obviously, we don't want demand to shrink too terribly much. But what I will tell you, and at least in automotive specifically, is there's pretty hefty demand planned from a tooling and new product perspective. So we have a lot of new vehicles coming out in the market in the next couple of years. It's really positive, so we absolutely have the demand to do so. The challenge is if they're able to run their businesses to still make money, even when the demand is still there. Does that help answer?
Yeah, actually, it does.
I have two questions about the long run. In my previous life, I was a professor at Michigan State, so had students from Michigan. And in my senior seminar on the current state of the economy, and I taught it for about 15 years or so, the last time I taught it was 2019. And the question that I posed at the beginning of the semester is, do you think you're better off than your parents were at this age? And for the first time in 2019, students said, post-Great Recession, they said that they thought that they were better off because they had interesting jobs that their parents had to work on the line, and that they thought these were boring jobs. So, people don't want to show up for tool and die jobs. My students' reaction would be, that's boring, that's not the Apple Store. So, that seems long-term. That seems structural. So how do you address that? I mean, how do your businesses say that they would address something like that?
Yeah.
How do you make manufacturing sexy?
Yeah, that's the end-all question that we face almost every day with our businesses. It's very challenging to make manufacturing sexy, I'll tell you that. I would tell you that if you go into the average manufacturing facility, there are floors that I would eat off of. I mean, there are impeccable facilities in this country. They're beautifully maintained. Everything from, yes, OEMs and tier ones, very large companies are doing a great job, but I walk into $10 million plants that are beautiful, have state-of-the-art equipment. You've got 20-somethings working on $1 million machines and coding that never got a 4-year degree but went to an apprenticeship program and are doing really cool stuff. The biggest challenge we have is encouraging more people to do that. The only way that we found success so far, at least our clients have, is they've focused on actually talking to the parents at very young ages, so starting in like elementary and middle school, about the benefits and the career development opportunities in manufacturing that don't require a 4-year degree. I have a 4-year degree. I know many people here have a lot more than one 4-year degree, so I understand
Smart
the benefits
rent.
of higher education.
Scam.
But it doesn't mean that everyone needs it. So we're focused very strong on trying to encourage people to go into manufacturing because I'm a nerd for it, but it's really cool.
So I have just a quick question, and this is a longer term question too. So to what extent, because of these labor demand challenges, to what extent have businesses adopted automation to fill the labor demand?
Yeah, they absolutely focus on automation pretty clearly all the time. I was at, you spoke about big conferences. I was at the International Manufacturing Technology Show in Chicago a couple weeks ago. Actually very well attended, so that was positive. I stayed at a Marriott. I'm sorry about that. But either way, we were at that show, and the core focus was on automation. So it's everything from automation within a machining cell. So if you're cutting a piece of steel, they're really focused on how do I have multiple pallets to make sure that I can do things without people, right? How can I run this machine for 24 hours and then have some guy sitting at home on his cell phone being able to monitor it? Because, I mean, they have that technology today. Every machine monitoring company will give you an app on your phone. So they're focused quite a bit on that piece of it. There's also a lot of automation in terms of lifting and material handling, and even in terms of some of the warehousing pieces of it as well. So how do I get a machine to wrap a box? And how do I get, frankly, any automation to do what even in manufacturing we may call the less intriguing jobs, so that we can have people actually making parts and actually designing and actually checking quality and doing the things that are, what I'll say, more fun than packaging a box of parts, right? We have, at this point, automation that can do that.
I just have a quick question. I think Chris and I are kind of going in the same direction on these questions, and I'll ask it to you, but anybody else can jump in. So in a normal economy, if demand softens a lot, first thing businesses do, they often will lay off workers. This seems like an unusual economy where businesses have been scrambling to get workers for so long. If demand softens, do you think they would respond differently this time in terms of those workforces, or do you think they just would do the kind of usual playbook in terms of trying to shrink costs?
Right, yeah. It probably depends on the business a bit. Obviously, everyone's different, and I don't know all of them, but I do think they would approach it differently. I think one of the things that, at least in our space, they may consider doing is looking more closely at who is it that may actually be close to retirement age anyway, that we could help them, and now they maybe feel comfort to be able to leave the workforce. And then how do we get that tribal knowledge out of that individual before they leave, right? The big thing with our workforce is going to be that the people who may necessarily want to leave the workforce at some point in time, they have all of the knowledge on how to do everything, every average good that we see in this country, right? There's some guy sitting in an office that's a tool maker that knows exactly how to manufacture that part. I don't think they would do massive rounds of layoffs, but I do think they would potentially strategically say, hey, frankly, let's rank our A, B, and C players, right? Who adds the most value in our business, and who are we hiring because we were just really desperate for people in this massive demand surge, and they may choose to let go of some of those individuals. But that would always, for them, be non-skilled labor. I can't see any circumstance where they would get rid of skilled labor, and would probably not be a critical mass of their workforce for the most part, at least in the privately held businesses I work with. I can't speak as much for the publicly traded guys.
Thanks, everyone. Thank you so much to all of our first panel and our panelists, Tom, Chidi, Jess, Kara. All the information that you've provided and shared with us today really just helps us better understand the data that we look at here at the Federal Reserve. So now we'll take a quick break. We'll come back in about 10 minutes.
Thank God,
and,
dude.
Vice Chair Brainerd will chair our second panel. So thanks, everyone.
Thank you.
Thank you.
Really interesting.
Thank you.
Thanks for your time.
All right. What'd you think, man? What'd you think about the whole panel. How was it, chat? Was it good? Satisfied? Happy? I don't know, man. Like, Jerome Powell speaking, I get it, but I don't know if that's more valuable than looking at all these charts. I've been trying to go through different ones. I don't know if you've been paying attention. If you're just listening, you're kind of missing out because I've been scanning through multiple charts on the stream. And here's Tesla, still with about 24% downside. That's the target, $209. And yeah, maybe eventually 189, really. But yeah, you confirmed a top. You're below the 200-day moving average. There was bearish divergence on the second top on both oscillators, below the high from January 2021. Yeah, man. Another lower high put in consecutively. The downtrend continues. Lower highs. Here's your high. Here's your low. Here's your lower high. Here's your lower low. Lower high, lower low. Lower high, lower low coming, most likely. And if not a lower low, then probably the same low, which again is 24% down from here. You could imagine how the index funds are gonna make lower lows than the ones we saw in June. You gotta look at Google, Tesla, Apple, Microsoft. Here's another one, right? Microsoft, holding up relatively well. It's only down 1.61%, but today it made its lowest low since April of 2021. Right, took out that low from May of 2021. Took out its June lows. So, downtrending, and I think there's a lot more pain in store for us. We can look at Amazon. Understand that, after testing not just the 200-day moving average as resistance, we tested the old ice line, just confirmed it as resistance. Now you're rolling over, and the target from here is 101.80. You'll be there in time, down 3.81%. I mean, you're about right at oversold. You're at 30, so you're not technically oversold yet, but you're very, very close. So the downside on these assets is how it is a very real possibility that the index funds continue to get destroyed. We can look at the semiconductors like NVIDIA. That is also a huge market cap asset. And we know where that's going. Well, first off, 117. But after 117, bye-bye, NVIDIA. After 117, straight down to $73. So you might react here again. But when you react and you rally, you are not going to take out the highs from August 10th. You're just not, okay? This is a perfect bearish setup too. The bearish shark in the downtrend with a type 2 return with bearish divergence on the second high. That's the dream, man. That's the dream bearish shark continuation pattern, the Jesus. Okay, so I would say like in time, and I'm not saying it's going to happen immediately because you're going to test 117 and it very well could be a level where we react for a while and hold for a while, a short-term bottom. But once you break that, you got 40% downside on the largest chip maker in the world, or the best one in the world. 40% downside. You ready for that? You get why the index funds could go to Earth or under Earth in the ground? AMD, the other one, the other king of the semis, it's over till 59. And after 59 is 48.51, which is the tech bubble, the 2000 tech bubble peak, 48.51. So minimum downside where you are right now on AMD, minimum, you still have undeniably 12% downside. And that's where you might react, you might hold for a little bit, rally, make a lower high, who cares? After that, you've got a good 27.8% downside. And then eventually your big one, talking 48% downside on AMD. You ready for that? This definitely looks like an 886 in time, like a massive bubble pop, right? Where the 886s, right? I mean, so many have already done it, but many haven't. And you could imagine an 886 is down here in the like $20 or lower maybe. What a run on the way up, but now it's the inverse. It's literally the inverse of what magic rally we had. So Yeah, we could plot a channel too, dude. A lot of these semis have these nice established channels. This one was kind of weird. It like broke it, you know. But I bet if we adjust for the bottom, though, if we adjust for the bottom, it's probably really decent. Doesn't make as much sense because you couldn't even hit the supply line. But that's probably something you got going on now. Something like this. Again, it's not supposed to be perfect. It's just something that helps you. Sometimes the channels are better, well respected than other times, and this is probably the way it's looking. So yeah, 59 bucks, 12% plus downside here. Yeah, you're oversold. I get it, man. Anytime you could rally off that, you could even come for a back test to $74, but only bearish. Only bearish. But dude, we were pumping, man. We were gonna pump. What happened? We're in power hour, chat, remember. We got 34 minutes till your daily and weekly candle close on the stock market. Mother of God. The financial stocks are so destroyed. They're so done for. This was beautiful, classic distribution, right? Wyckoff distribution, last points of demand or whatever. But look here, you broke 43 bucks, which is a very real level. The downside potential, where you're probably going next, you got another 9% downside before anything even makes an inkling of sense. This is probably across the board for these financial stocks. Terrible. They've been terrible. Like, so ugly. But then, hey, chat, guess what's happening today? Big deal. This is not a joke. Hey, dude, you're getting a Dell. You're getting a Dell that is breaking below May of 2019 highs. October 2020 highs. You get how there's almost nothing. Well, there's nothing till 29.95. Okay. But really, man. Beyond that, 21.37. That's the hard target, most likely. From where you are on Dell, 15% downside, and there's no question about it. But if that doesn't hold, which does seem possible, that may not hold at all. Full reset takes you down a good 40%. And what would that be? Just think about the low, the COVID crash low to the high. An 886, you're in between the 786 and 886. It makes plenty of sense if you know about Fibonacci and cycles. This is a perfect target area because you got that low too. Yeah, 786, 2345. Your longer term target. But dude, you're getting a Dell, so buck up. Ooh, my God, man. Oh, nice. The container supply, or the container store, just had this plotted here, waiting for it. You'll see 380 in time. It's been that way like $3 to $8 ago. Man, once you broke 930, it was that was the target.
Thanks.
Easy. Everything made sense for it too. What's up, Scott? Thanks for the 20, dude. Joe, I don't know, man. Don't know they'll stop lending. They have to lend to get interest.
It's China to me. China.
If banks tank, will they stop lending?
Yeah, good question. I don't know, dude. If I can't answer it with traditional technical analysis, I can't tell you, dude. All right. So on this trash, where there was, I mean, it was known. If you were below 930 in time, the target, you had 60% downside. Well, most of that's played out now. Sorry. But you still got another 30% downside before you see a full reset 886. It's coming, man. If you're just patient, you'll get it. Oh no, I haven't looked at the requests yet. Let me check those out. As the VIX is trying to climb back a little bit. This is 60 minutes, so yeah, it's like it's so dramatic, man. It's not really, right? You get the 4 hour, it's kind of like 4 hour on the S&P futures. It's like, oh wow, it's pumping so hard, dude. All right, let me get these requests. All right, the first one we had, it was a request. It was Meta. Gladly look at Meta because it's a dumpster fire. Rightfully so. But, you know, starting to get to formal levels of actual support. I mean, yeah, this is some of your strongest support areas probably on this chart. You're talking about a peak from November 2016, a valley from 2018, the PCZ of the sharp cipher, March 2020, the bottom. You're there, and it's just like you think about what the worst thing in the world had to happen, right? The whole world economy had to stop. Heart attack, right? And now you're rivaling those levels, and you will be taking those levels out. You will be falling lower than 137.40, the nadir of the COVID crash. You will be testing 133. You will have our sausages. Okay. Below that, you will go to 114.37. So yeah, it's a channel of sorts. You could call it a wedge, man. It's just, this is the channel you're in. This is the trend you're in. It's bearish. No buy. Don't buy, man. Stupid to buy right now. Why would you buy? It's not even oversold. It's close, 31.5, but bearish controls on the daily. We can look at the weekly. Weekly is awful. Follow through, confirming that it's almost a bearish engulfing. Yeah, there was hidden bearish divergence. You're bearish 33 on the RSI on the weekly, dude. Soon this level, and then after that level, probably 114. Okay, after that, wow, you could talk about an 886, like a full 886 from the low to high. 886 is $60, and if Facebook suddenly one day is at $60, who is going to care? No one's going to care. Back here, this is like, it was like this ridiculous, like 95% of millennials had Facebook. Now they don't. Barely anyone uses Facebook. No millennials use Facebook anymore, okay? So why could this not be at that level? That's what it was. I mean, these social media companies.
Weekly, please.
Well, look, Josh, thank you. These social media companies are based on their projected numbers, their growth. They have no growth. They are losing people. Right, and advertising revenue, I guess. I mean, that's about all they got, man. One show pony, Facebook. So $60, I could see that for sure. In time, if you're patient. That's your meta, dude. All right, let's look at Neo, the next request in order. You want to look at it. It looks pretty awful right here. Where you truly think if Neo was gonna do it, it would not be putting in a lower high and rejecting the 200-day moving average. If this was truly bottoming, in my opinion, you'd be breaking 23.77 and running to 31.88. That's not happening. Yes, pattern completion zone of harmonic. This is dudding. This is not the performance you're looking for. You shouldn't be range bound like this, okay? The target from here, again, is 1380. So where you are right now, there is still a good 22% downside. And once that breaks, which I have belief that it will, based on what we know about full resets in Fibonacci, and 886 is well below 1380. If you want to look at it, we can. From the lowest low to the highest high. The 886 is 878. It lines up with the peak from October and December of 2018. And a gap fill. There's multiple gap fills down there. That's the target. So I think from here in time, if you're patient and you wait long enough, you will see 50% downside on NIO. a full reset, which would make an X, A, B, C, D. What would that be? It would just be this massive bullish bat pattern. This is what it'd be. Bullish bat pattern, chat. Perfect. Okay. That settles it. Thank you, Scott, again. Panels talking again? Oh man, I'm so excited. God.
Strong national response. We had strong government response. We had strong charity responses, and we couldn't be more excited about that. But that enhanced support with unemployment assistance, stimulus checks, child care assistance, homeowner assistance was wonderful. But now that we've combined it with inflation, that means that the problems are cropping up all over again. What's different this time is that the level of support that we received during the pandemic is on the decline. Feeding America itself estimates there are probably during the pandemic around 53 million Americans across the country who weren't really sure where their next meal's coming from. Let's wrap our heads around that number. That's a lot of people. It's a lot of children. 1 in 5 of our babies don't know where their next meal is coming from. In Central Florida, we estimate around 500,000 are food insecure and aren't really sure where their next meal is coming from. And most of those individuals are suffering from a recovery period. I once heard a stat that was around the fact that most of Americans only had around $400 set aside for a rainy day. So think of that rainy day fund pre-pandemic. Think of that rainy day period through unemployment and the challenges that we saw during the pandemic. Think of how long it'll take to recover when you've lost a job or someone in the family has lost a job. And that basically brings us to today. In Central Florida, before the pandemic, we were distributing around 150,000 meals a day. During the pandemic, that number went up to 300,000 meals a day. And today we're leveling off at around 250,000 meals a day. Now let me add a little additional context to that. In 2019, around January, a gallon of milk was around $2.90. Today it's over $4. Now, if I'm someone who was struggling with food insecurity at the $2.90 mark, the likelihood of my being able to recover from that today is somewhat slim. And I don't know about you, but very rarely do we go back to the grocery store and see those prices return back to where they were 2 years ago. So we hear so many stories from our clients. We distribute our food through a group of about 500 partner agencies. These are soup kitchens, food pantries, and the like.
About to confirm double top. If close below 27.69.
Providing food for those who are experiencing homelessness. And we're hearing a variety of different kinds of stories.
Life-changing homelessness. Thank you, dude.
I'm having to sell my food stamps in order to get my rent paid. That's today. From, the script has flipped. First there was a shutdown and lack of income and funds. Now 2 years later, we're paying back everything and it's hurting more than ever before. $40,000 or $50,000 used to really matter. And now making $40,000 to $50,000, I can barely get my rent paid in Central Florida. That's what we're looking at today. And I'm going to probably answer both of your questions that I have with this, if you don't mind. Something that we like to say frequently, and I might have been faced this myself when I first started, is the face of hunger really isn't what we think. We automatically default to this preconceived notion that you're either homeless, you're unemployed, or you just don't want to work. When a significant portion of those that depend on our services day in and day out are working families, some of them working multiple jobs. And they range from seniors, they range from who were on a fixed income, or now that the pandemic has passed and we're seeing heightened inflation, that they may be taking care of one of their own children or taking care of their grandchildren. So it's that same fixed income, but the cost is even more. In addition to that, just the normal family, we're seeing families bring in other families and families combining themselves just so they can make ends meet, and particularly when we're talking about the rising cost of housing that we continue to see. So that's what our clients are seeing, or those who depend on us are seeing on day in and day out. But those challenges, our food banks are not immune to those challenges either. We're still businesses running day in and day out trying to provide these services. And we are seeing challenges from a food sourcing perspective. Tom and I were talking outside when we mentioned the drought that's taking place. We source a significant amount of food from farmers. And if that food isn't there, then we're going to have problems sourcing it. We typically we get food, or most food banks get food in three ways primarily. There's the food that is donated to us throughout from the retail channels. There's food that's provided to us from the government, from the USDA. And then there's the food that we purchase. On the average second harvest of Central Florida, we would spend around $2.5 million on an annualized basis pre-pandemic. This past July, we had already spent $6 million. So that's then 25% increase in transportation costs. We put 22 trucks on the road every single morning. That's the cost of food that we're having to see and trying to procure that food. And that's also with the increased demand that we're seeing for that food as well. So those are some of the issues that we're starting to see day in and day out. It's short, but it's very to the point. We don't see anything ending anytime soon. In fact, we're about to go into the holiday season, and every single one of us in the room probably associates food and family with the holiday season. But there'll be millions of Americans who won't be able to do
Finally
that.
catch you,
Millions
Mitch.
of children
Cheers
who
from the
will not
UK
be able
mate.
to do that.
You have helped me out
based
no
on
end.
the economic
Appreciate it.
situation that we're seeing today, because so many of them simply have not recovered. And that's what we're seeing. And again, thank you again for the opportunity to just bring this issue to the surface on behalf of myself as well as my other 199 peers across the country.
Let me ask my colleagues if they have questions. If not, I do have one follow-up. So I'm still struggling a little bit. We've got this hot jobs market and wages have grown a lot and food security is really fragile and it sounds like no relief in sight. So how do I reconcile those things?
I'm not entirely sure how you reconcile those things, Governor. We're asking ourselves the same question. When the need increases, we've been able to scale so far. Again, the challenge is simply around those that we provide services to are struggling to recover. We're also seeing the demographics change a bit as well. We used to automatically associate hunger with low income. We're starting to see middle class be a part of that as well, whether it's based on the long recovery period because of the pandemic, or it's just simply challenges that they're seeing. 40% of we've seen a 40% increase in people who are seeking out our services for the first time. I wish I could hear some of those stories. I never, ever thought I would be here. We were doing fine a couple of years ago, and now we're literally struggling to make ends meet. Whatever little money we have runs out around the third week of the month. And thank goodness we have food banks that we can depend on. But there's only so much that even we can do because the gap really didn't narrow from what we are distributing on a daily basis. We're not seeing that gap today, Governor. In fact, we're seeing that number increase.
Can I ask you more? This is just kind of a data question. So of all the people you service, what fraction would be, say, elderly, retired, working, poor, non-working?
We are not capturing a significant, and I can give you dated information on that. We don't have that information as of today.
Oh.
All right. But what we would typically see is, let's go back to those experiencing homelessness. That was a less than 10% number. What we saw with those that were working, that was in the high 60 percentile range, pushing 70%, working at least one job, and in so many cases, even more than that. So those are the numbers that we're starting to see. We'll get new data probably toward the end of this year, but based on the fact that we're still 40 to 60% higher than we were pre-pandemic, the likelihood of those numbers changing very radically is pretty slim.
Yeah, so I guess this goes back to Governor Brainer's question. You have people who are working, they're in a hot labor market, but they're not earning enough to even have food security.
Absolutely. That is the challenge that we're seeing.
Can I just ask, if you've spent, or if you're using up $6 million by July, how do you expect to be able to continue to provide the same level of service throughout the rest of this year and then into next year? How are you thinking about how you'll be able to continue providing this vital service to these people in need?
That's a good question, Governor. Thank you. We were very fortunate during the pandemic. The community rolled out in ways that were unimaginable. But now is the time that we're spending down on those dollars. We expect at the current rate, we expect that to last maybe about another couple of years max. However, we don't see the need decreasing. We don't see the need decreasing next year, nor do we see the need decreasing into 2024. We're hoping toward the end of 2024 we may start to see things level off a bit.
Your funding comes mostly from government, mostly from private donations, from long-term foundations, or where does it tend to come from?
From a Central Florida perspective, the majority of our donations come from individuals. Which is very comforting. Around over 60% comes from individuals. So we're hoping that will continue, even though it's starting to decline, not a steep decline. But I think a significant portion of that is the thought process or the misconception that this thing is over, and it's not.
All right. Well, thanks, Derek. We're going to move next to Dr. Brenda Hellier. Brenda is the 5th Chancellor of San Jacinto College, which is the 8th largest community college in Texas and a national top 5 community college as recognized by the Aspen Institute. Before becoming Chancellor in 2009, Brenda served in a variety of roles, including Executive Vice Chancellor, Vice Chancellor for Fiscal Affairs, and Executive Vice President for Resource Development, and previously was in the corporate world and a small business owner. So Brenda, thank you so much for being with us. It'd be great to hear a little bit about what jobs you are preparing your students for, whether those jobs and skills have shifted in this
like she knows
post-pandemic
anything about the real world.
economy. And as a result, whether you've made changes to your educational offerings to help prepare your students for the job market that we're seeing today.
Thank you, and thank you for having me here today. I'm absolutely delighted. So San Jacinto College is in the Gulf Coast region. We're outside of Houston. We have this fall about 31,000 students. We are down about 2,000 students, or 6% since fall of 19, which is our prior pre-COVID numbers. We serve about 65% of our students are Hispanic, about 10% are Black, and our white population is declining about 17% right now. 42% of our students are first generation to college, and if I look by demographics, about 48% of our Hispanic students are first generation to college. Our high schools, or our school districts in the area, they are about 75% on free and reduced lunch, and so pretty high economic needs there. From a standpoint of breakdown males to females, we lost a lot of males during the COVID. From that enrollment standpoint, our males had been at 41% through COVID, then they were down to 38% of our enrollment. It was almost all the decline were in our male students. We are back on a percentage right now. Where we are seeing a decline still is with our Black males coming back to school and really reaching out into them. when our enrollment, when I look at the pieces of it, our first time in college students are kind of flat right now. We had lost quite a few from those May 2020 graduates. They didn't go anywhere. When we can see that the college going rate in our community was 52% before COVID, those May 2020 graduates, it was only 45%. So I'm really concerned, where are they? How do we bring them back? We've seen increases in first-time and college students since then, but we've also seen a decline in our over 25-year-old students. And so that's an area that we're really reaching into to understand what's going on. So of our offerings, about 35% are directly tied to workforce training. And so getting into the jobs, we're in the heart of petrochemical. We're in the heart of maritime, aerospace, and then the health sciences. And so those are the major jobs we're training for. And we're very lucky for the relationships we have in our community. And when I say that, in petrochem, there's 133 petrochemical companies in our region. And so these are great paying jobs. One of our graduates will come out and make $65,000 the first year, and that's with an associate degree. The other thing that was really important is before COVID, before the pandemic, we had very strong relationships with industry. All community colleges have advisory committees made up of industry people who serve on them working on curriculum. We also at my college have an advisory council. It's a chancellor's advisory council, and it's C-suite. I mean, it's our plant managers, our VPs, and our CEOs meeting with me and members of my team, and we're really focused strategically on workforce needs. So with petrochemical, right before COVID, we had opened a $60 million new training facility. And it was a facility, if you talk to industry, they'll say this is a facility designed by industry, for industry. It is a day in the life of an operator. It takes students all the way through what really is going to happen out at a plant. Even to a point, their last semester with us, they're doing shift work. They're doing 24-hour shift work, 8-hour shifts, so that they can climb the stack. It's a 2-story, 8,000 square foot training facility, but they're doing it just like they would at a plant. And it was a total redesign of curriculum. Industry wanted to rebrand in our community because you had asked the question, Governor Cook, about people living in these areas, that these jobs weren't sexy to them. It's what was happening with our youth. We didn't have a pipeline. And so we really worked with industry to redesign how we trained and how we recruited together, going into high schools, going into 8th grade, and trying to build. These are the jobs. And they're not the jobs that your parents had, where it didn't take a credential. So that's been important work. We've done the same thing with maritime. We're the #1 port in the country. And I heard all the logistics problems. That's exactly what we were trying to train for. Deckhands, towboat operators, tug operators, and so again, a program designed by industry, U.S. Coast Guard approved courses. We're right there on the ship channel. People didn't even know about these jobs. So the demand is definitely there. How it's changed is through COVID, our partners were nervous that we weren't doing the technical hands-on training because there was so much remote. And so we made it really clear how we were doing hybrid. A lot of the lecture piece can be online, but the hands-on, you got to come into class and you get that hands-on. You can't learn to run a control room remotely. You can't learn to run a tug if you're not on the simulator there where you're getting that. Another area where we really saw changes is in the health sciences, nursing. And so we have always prepared licensed vocational nurses, associate degree nurses, and we had just gotten approved from the state of Texas to do a Bachelor of Science in Nursing because so many of our hospitals were going to BSN. Through COVID, that's all changed. What we're doing right now is we're working on a pipeline from CNAs, certified nursing assistants, to LVNs, to associate degree to bachelor, so that our hospitals have that team approach. And it has really been, when I called them, they were like, no, Brenda, don't stop those LVN programs at CNA. We need you to help build that pipeline. In the state of Texas, something that's been very creative that's just starting is our Texas Workforce Commissioner, Julian Alvarez, has set aside $15 million so that we can have apprenticeships in nursing programs. So before, students were doing clinicals unpaid. That was part of the whole training for a nurse. Right now, that's being redesigned so that our hospitals will have state resources to help do apprenticeships to move them into these fields. So it has really been all relationship building. Tell us how it's changed, and let's figure out how we're going to redesign this together. And it has really, I think, served us well. We had a big industry forum yesterday, about 800 people, and it was focused on petrochem and maritime. The demand for those jobs are there. The biggest thing is, how do we make sure they've got the aptitude and the skills? And then how do we help build the attitude? Really building a safety culture, time management, all those soft skills that you hear about, we're building those into the curriculum. And that's what we keep hearing about from our industry partners. When I hear about the demand, same thing I heard on that side. The retirements, our companies have about 20% to 25% of their production people are ready to retire. They want our pipeline to continue. They said, don't pull back, we're hiring. And so they are pretty much hiring every recruit that we can put out of the petrochem. It's about 95% placement. And again, at a $65,000 a year starting wage, it's pretty impressive. Challenges, I can move to the second question, the barriers. The Higher Education Emergency Relief Fund that was provided to colleges has been amazing. What we were able to do with that, we received about $78 million.
Y'all wanted to listen, man. Y'all said, put it back on, man.
Directly into students' hands, and so that they could finish courses. We wrote off debt. We had them retake classes if they failed that first semester of COVID. We had them retake classes for free. We got additional training funds from Texas so that we.
Just gonna make an executive decision and just mute her until the next person comes on. Okay. Deal with it. Like, there's just nothing that she says that in any way matters. Nothing matters what comes out of her mouth. Do you understand? Nothing. But we'll give her that small section of the screen. So look at Hasbro, dude. Broke support. Yesterday? No. A couple days ago, back tested as resistance since collapsing, and the target's $65. And when $65 breaks, bye-bye. Bye-bye, Hasbro. Toy manufacturing company from 65 to 50.
China stock for you, Mitch. Can you take a look at and see? Thanks.
We'll do it. We'll look at it, man, okay? Bitcoin's hanging. Dude, Bitcoin is awesome. Like, for real. We can stop for a second and just look at Bitcoin. We will look at these requests. Like, no doubt about it. But it is amazing. I figured Bitcoin was done. But it's continued. It's decoupling. It will not break down. It won't. It is. Buyers are still defending this level. It's absolutely impressive. But at the same time of buyers defending the local support from June 30th this year, you're still below, well below the inflection points you desperately need to be above. It's so big of a deal of a level that you can't be bullish here. You cannot. If Bitcoin does this, you could become cautiously optimistic, but still not bullish. Okay, so because the trend is so bearish. Only lower highs, lower lows since November of last year, or at least a little after November when the lower lows and lower highs got put in, okay? But it is very impressive locally and lately. The locally, look at me, lately, Larry. All right, so.
Is this your homework, Larry?
That's your update on Bitcoin. Oh, Jerome's talking.
On
Missed it, dude. And I got her wasn't quick enough to the draw. Wow. Okay, so the Jesus chimes because the stock market has now officially closed. Ding, ding, ding. Let's go to the S&P 500 and check out that weekly, a fresh candle close. Just blew out the candle, man. There it is. Not quite your lowest low. Still a higher, still traders settling up lower on the weekly than they did June 13. Nice. But hey, the maturation of the hidden bearish divergence is complete, and our first negative momentum histogram wick confirmed. Until Monday, we get another one. I think the target's the 200-week moving average minimum, which is around 35.80. And something's happened. You are in the bearish control zone on the weekly on all the index funds. Nothing bullish about it. I don't care if everyone else is bearish. I don't care. I've never given two craps about what everyone else says. The charts dictate my opinion. And it's so bearish. Dow Jones. Fresh close. Okay. Your lowest weekly candle close on the Dow Jones Industrial since November of 2020. Goes in the chat for the DJI. Also, another G. Because the Dow Jones Industrial has closed below its 200-week moving average for the first time since May of 2020. That happened in the end this week, today. At the same time of falling below that level, you are in the bearish control zone, sitting at a nice 36.4. But one thing, the weekly candle closed right at the February pre-COVID crash high. That is where you closed. So lots of things going on here on the DJI. Can you hear me? Does anyone even care? Or would you rather listen to Karen speak about stuff that doesn't matter in the real world? No one cares. The NASDAQ composite. Very, very, very bad. Closed below the weekly 200 moving average for the first time since the COVID crash. And the next week, it was the bottom. The Federal Reserve intervened and went all the way up to all-time highs. That's not happening this time. It's just not. It will not happen, Chad. You get that? Jerome Powell will not come in to save you at the 200-week moving average this time. He won't. So yes, you held that, 10,800 level, closed just slightly above it. But now you're getting very close to the curved line, that uptrend you've been in since 2009. Hidden bearish divergence has completely matured. You haven't even seen negative momentum yet. Next week will be the first negative histogram wick you receive. Hidden bearish divergence on the weekly manifested into us breaking back into the bearish control zone. Here you are, 38.18. Miserably bad. This is the worst, as some would say. The worst. Oh my God, do we really want to unmute the panel? You really want me to unmute this dude? For real? I'm not going to do it. I'm not doing it, dude. You're not going to make me either. You don't like it, tune out. Go watch another stream this live. There's probably plenty of them. Not unmuting it for this. Sorry. Imagine thinking what she has to say is more interesting than what I have to say about what just happened on the weekly on the index funds. Give me a break, dude. Last index fund. Possibly the worst. Hidden bearish divergence, completely developed. Yes, this is the worst. Now, you didn't close lower than that June 13th week like the others, right? S&P didn't either. But you have broken critical levels. The high from 2018 and the pre-COVID crash high. You are below them and traders have settled up below them. You are in the bearish control zone 39.4. This is as set up as it gets for a market meltdown. On the weekly anyway, for massive drawdowns. It is set up like that. No, we could double bottom. I just don't understand how you don't get the whole Federal Reserve not going to pivot and intervene like they did. They're not going to do it. Inflation's way too high. It doesn't stop. They're going to continue to let this thing tank. Or this market is pretty much comprised of just the Fed and money printing now. Since 2008, everything changed then. If that central entity is telling you they're not gonna do it, you're gonna get more sell-offs from here. It's gonna happen. And probably closer to a 786, 886 eventually. 786 is 1281, 886 is 1130. And if not, F it, go to 1464 where there's a formal support of sorts. And then 1300, which is confluent with a 78% retrace. There are your index funds. Okay, Philip. Well, with whatever you're saying in your cryptic message there, you go ahead and go long, dude. Do it. Whatever. Do your thing, man. I've been bearish the entire year. The entire year. We had a bear market rally, which was probably the most insane bear trap ever, quite possibly. And now everyone's trapped again, and you're rolling over. And good, the bear trend continues. I agree, Robert. I'm not complaining at all, man. This makes too much sense. What's happening is like perfect. It validates everything that we look at on a chart. Everything's playing out except Bitcoin dumping. Bitcoin's not following, and that's the interesting dynamic. A new dynamic right now until something changes. As we go to Bitcoin, it is terrible, okay? It's miserable on the weekly still. Like, I think it's awful right now on the weekly. I wouldn't touch this right now on the weekly. You had a nice, successful bearish back test of the supply line of the downtrend you've been in since the top of November of last year. Not only did you test that and fail miserably and get rejected, you had a bearish engulfing candle that gave you pretty much close to the lowest low you had seen of the entire downtrend. Not only that, it gave you a bearish candle close below the previous cycle top. All those things happen. And this week, what's happening? A break, and now you're getting a hook. The break, hook, and go stuff, right? A successful bearish back test is in the midst of occurring here. We have 2 days and 4 hours until it is confirmed on the weekly that what was once a resistance from history chat a couple times is now resistance again. That's imminent unless a literal miracle happens in 2 days and 4 hours. If a miracle doesn't come or happen, successful bearish breakdown. Do you understand? Since June, Bitcoin has never done this. It never did it. Look at June 13th. Traders settled up higher than that level. Then the next candle above the level. Then you broke it on the 27th. And what happened? Immediate rejection. Immediately getting back above that key inflection point. Then a back test. Then you didn't see it again until August 22nd. You closed below it. Oh no, Monka S. But then what happened? The next week, traders settled up right back above it. And then a rally ensued. But now, it's changed. Something's different now. And I hope you can see that. Hopefully I'm able to articulate it well enough for you to understand and see what's different about this week. from all the other weeks that we've been down here flirting with this level. Not only that, the hidden bearish divergence argument is continuing to develop. Next week, we'll probably get a lower histogram wick. I hope not, but it's not about hope, man. It's about price action correlation to key levels. That's all it is.
Thoughts on Qs/TSLA weekly as well. Thanks.
Gosh, yeah, we'll look at it. All right, let's switch back to the. I just want to look at the weekly close, right? Let's real quick just look at a few individual assets on the stock market on their weekly, so you can see how bad they are. Remember, we had a bearish engulfing candle last week. Now we caught the follow through to confirm how bad it is. Google, lowest weekly candle close since January 2021. That's confirmed. You broke the levels from, early 2021. It's over. You broke them. There is nothing here. Nothing left. Very, very bad. Let's just look at Apple. This is the worst. It can't get really much worse than this. Classic distribution. And what happened last week? A confirmed bearish breakdown below a level from 2021. And this week, a massive rally to successfully backtest that level, reconfirming its validity as resistance. And then a big sell-off after, and you have that beautiful hidden bearish divergence there. It's just now beginning to play out. So you would think more downside is in store for Apple, which will certainly drive all the index funds down more. Amazon. This is really, really bad. Understand you are below the 200-week moving average. Last week, you got a bearish engulfing candle below it. This week, we got some really nice follow through. There is your bearish edge in a bearish trend. And the target, of course, still is 101.80. Microsoft wasn't too crazy. It's not the others, but still your lowest weekly candle close since March of 2021. Bearish engulfing candle last week, caught the confirmation this week. And yes, your hidden bearish divergence is beginning to play out. You are sitting in the bearish control zone undeniably on the weekly, daily, you name it, man. The target, at least, you'd think is a 200-week moving average around 212. But now let's go to Bitcoin real quick because it is doing some stuff, man. It's really trying here. I figured it was going to collapse. It looks like it was. It was making local lower highs. And then the stock market and the VIX, and it doesn't matter. I think maybe, for now, there just aren't enough sellers. Not yet. I don't know what has to happen. Lamar, you need to get your eyes checked, dude. Seriously need to get your eyes checked. Wow. So the great news is, right, we all here know we have a thesis, and the good news is we don't even have to think about it until it breaks 19,891. I'm willing to miss out on $1,000 on Bitcoin just so I can have solace and understand that we're above the previous cycle top, because I think that's everything right now. The fact that we're below it, we're back testing it as resistance multiple times, we're making local lower highs. I don't care if we're making a little slightly local higher low. I don't care until we break 19,891. And then from there, it will only raise more questions. It will not at all reverse a trend. It won't do anything yet, but at least it'll be something. Until then, it's hands off limit Bitcoin. I'm sorry, dude. It just is. If you're enjoying the live stream, hit the like button, the bell, that sub. Thanks for being here, everyone. Dang, dude. That is lit as that chat. Look at this. Oh my God. Jesus chimes for freaking Jacob Twitch. Look at this, dude. No way. He's got the merch, man. He's got the blanket, all the Vegas pillows. Look at the harmonic pillow. That's the Japanese candlestick pillow. The Vegas meetup shirts. Let's go, dude. Amazing, man. Thanks so much, dude. That's supporting the channel. And I hope it's comfortable too. And educational. All right. What else is closed? You know it, gold. Let's look at that weekly close. You're going to hate it. Or you're going to love it if you have puts or you're short on GLD or gold spot itself. It's wonderful. You got to love it, man. The lowest weekly candle close on gold since March of 2020. Last week we closed below, just barely closed below the 200-week moving average. This week we back tested the 200-week moving average and horizontal line, support resistance, as resistance again, and massive follow through. The target's 1522, and there's nothing even else to talk about. 1522 in time, so about what, 7% more downside maybe from here. It was 9% yesterday. Now it's 7% downside, 7.2% downside. Yeah, I mean, bearish control zone weekly, negative Momo building. It's only bearish, and it's only the eye of Sauron. Only Sauron. The daily, I know, yeah, right, you're below this level. It's like perfect, beautiful. It's over, dude. Over for gold. That was the level. The buyers had to defend. They didn't. In fact, the sellers defended the old support as resistance. Bitcoin's going to do all kinds of things, man. The weekend's here. All kinds of effery's afoot. Clearly, there just aren't many sellers. There aren't enough sellers to push Bitcoin down for now. And probably not. And that's probably, it's not going to happen this weekend, I would assume. There's just going to be more bullcrap, 5% swings on everything in crypto. Have fun with that, man. You can have fun with it, dude. But like it's just, there's only one thing, man. Until you get above 18,981.99, you cannot give a crap about Bitcoin. You're not far off, man. I mean, you're gonna miss out on a little bit, but I'm telling you, missing out on that little bit is definitely worth it. Because below what we know historically, what can happen to Bitcoin if we stay below this level that we are below right now long enough. You could be going straight down 17K, 14K. So I'm just, you wake up, oh my God, Bitcoin's down 7%, 10%, altcoins down 25%. It can happen anytime you're below this level too long. Above it, hey man, it's probably not going to happen. It's like you got less probability of it happening when you're above 19,891. Yeah, that's what I'm saying. So you'll forgive me if I'm very prudent and cautious right now. Even if it looks okay, it does. It's. I'm not taking anything away from Bitcoin. I'm saying it is holding up surprisingly well, very well compared to everything. Love it. 1 Bitcoin equals 1 Bitcoin. Let's look at real quick, because commodities are closed, man. Or you right? I mean, natural gas. What happened? UNG. Here's the daily. Oh, that looks like an interesting candle. What about the weekly? Weekly's nasty. Lowest weekly candle close since July 5th on natural gas. Look at the weekly bearish step. Man, this is hard to ignore, isn't it? Like, I get it. It could just pull a DXY and validate it and say bullcrap and just keep pumping. But wow, the clear and concise bearish divergence class A after hitting, on the daily, it's a level. It's not much of a level on the weekly. After testing that daily high, I mean, 1 time, 2 times. You haven't made a lower low yet. Most recent event's the highest high of the run. So you can't say the trend's reversed, but you can say there's some buyer exhaustion and it could manifest into something more significant. So you got that. Yeah, if you're a lousy. Okay, dude. But what happens if you were already short way higher? Way, way higher. It's funny. It's like, we're going to pump just because people are bearish. People have a reason to be bearish, man. US oil weekly, how'd it close? Lowest weekly candle close on US oil since January 3rd of this year. Closed at 78 bucks. Perfect. That's the level, man. That is the key. The next one. TA is being respected, right? Straight up, straight down. You did it. You went straight down to the next level. Let's go. No edge. Bearish control zone. Lowest weekly RSI on US oil since, wow, May of 2020. Nothing bullish about this, man. At all. Nah. You said anyone saying the DXY is getting rejected right now is using that word erroneously. There is no rejection on the DXY. What are you, crazy? It's been rejected. No, it hasn't. Rejected, by the way, of 1.53%. Rejected, by the way. Oil, yeah, I mean, I'm not really concerned about a harmonic right here. I'll take it one at a time. I think it could go to 75 bucks. Now, below 75 bucks, boom, $61. And then we'll talk after that. We'll reconvene after that. But we got to see what it could react here and rally or something. But you're at it, right? Where you'd fallen below $100. Okay, the next target $78. Well, it was hit. It was hit today. So what now? We would wait. TA respected. Orange juice is the Jesus. Orange juice knows no bounds. Second highest weekly candle close on orange juice futures since 2017. Second highest. Oh man. It's about to get all stupid up in here. Orange juice moon boys unite. 191 tested again soon, and then maybe soon 204 to 210 would be coming next. You are certainly not at fresh long areas, but wow, you might be seeing the top end of this massive range, multi-year range. Kangs, dude, the Kangs. We know how live cattle futures was killing it, but ended kind of down, but still, very elevated, still broken out. Silver had it close the week down 3.7%. Very bad. Very, very bad. So this 1982 level is a monthly candle high close. So important. You regarded it, you like tweezer topped. Below it. You're below the 200-week moving average. Nothing bullish about it right now. Nothing. How about wheat? Wheat couldn't break that one level at 919. Look what this is. So real of a level, right? 919. You tested it and pulled back. It was a Putin thing, right? But hidden bullish divergence completely developed. If you ever break that, could be going to an 886 up there, way higher. But still, the trend is still intact. If you can even barely, but still, it is intact. Soybeans, still making a higher low on the weekly, isn't it? Couldn't break that resistance at 1454 though. Been testing, can't break it. You did get a 1585. Corn futures, nothing too crazy about it. I mean, yeah, you're above like this level from 2011, 2012. You closed above it, that's nice. If you stayed above it long enough, you would probably be going to 778 to test again, but that hasn't happened. But at the same time on the weekly, you can clearly see it's a higher low than previous low. The trend hasn't truly reversed yet. Wow. But sugar futures. Sugar futures looks done, and it's below resistance, but it's hanging on. It's holding that neckline at 1760. Coffee futures. closed the week right below that key inflection point, didn't it? Right below it. It keeps showing distribution. I'm very surprised it has not collapsed yet. It right now, as it stands, it doesn't look good, but it'll just keep violating the inflection point. That's what it just does. But one time, two times, three times you confirm less market participants own copper futures than they did February 7th. So that's the concerning part. Like, why is it? And now it's closing below. It's like, why would it not? It's time. You know, most time you never get 3 times. As we look at all the equities, even the index funds only gave us 2 peaks before it started rolling over and making fresh lows. So it's hanging on there. Cotton futures. Yeah, cotton futures looks screwed. I mean, you're closing right at the last line of defense. You break this, I think you go straight back down to 82, but then eventually 65. Yeah. Cotton had a really bad week. Past month's been terrible. Seafood, really bad week for seafood. As you can see, how close you are to death again. $100. That was the target. We've achieved it. Boom. That's it, man. That was the target. We're here. I don't know now. If we break the level, oh my God, I would think, if you're looking at the weekly, $83, $84. Yeah, $84 would be the next target from here. As you can see, it's been 2 peaks before, up, right? Down, up. I think that'd probably be it. You close below the 200-week moving average for the first time since March of 2022 of this year. So big top out, one high. Oh, it's the eye of Sauron here, dude. Seafood is Sauroning. The Tower of Beredur has been possibly developed, but you haven't broken the neckline yet. So, but yeah, massive confirmation, right? Anyway, I just want to look at the weekly close on the commodities, whatever. Again, back to Bitcoin. Man, the weekly is so pathetic right now. It's so bearish. It's doing the most bearish thing you could dream of. Even if it looks okay and is outperforming equities right now, the weekly takes out all the noise and lets you see what's happening. Yeah, event ended. Thank God. What a trash event, dude. You're wrecked. The entire panel, they're all wrecked. All right, man, I've been live for 2.5 hours, so, and early. So what do you want from me, man? I left it all out on the field today. It's cool and all that you're outperforming everything else, but it's not cool when you're below 19,891. But when you get above it, I'll be the first one to say, holy crap. Let's have it go. But there's just so, it's still, you breaking above 19,891's like, that's just like Frodo and Sam leaving the Shire on your journey to Mordor. Or Mordor in this situation would be reversing your trend and mooning. Okay. So you haven't even left the Shire yet. You're still in the Shire, dude. Cool. You can't be bullish on Bitcoin until you leave the Shire and head towards Bree to meet up with Gandalf. That's cool. Just hasn't happened yet, man. Yeah, we're out here dropping eaves. Oh, yeah. 111th birthday. Yeah, man. We could look at XRP because it deserves it. The Kang, man. This freaking thing, amazing. Went to 55.8 cents before pulling back. Probably liquidated those guys who degen gamble with leverage in front of a live viewing audience. Hey, man, they got stones. I'll give them that. So, yeah, I mean, just massive indecision right now. The swing today, though, insane XRP. Talking about a 22.5% swing in way less than 24 hours. Good news is you're currently breaking above that 200-day simple moving average, or you broke it yesterday technically, and you're still above it. And the last time you had even seen that level was back in March of 2022. So this could continue, man. 58.5 cents, I think, could be next. That's the daily candle high close from September of 2018. And then above that, 69.5 cents. There's a lot of price action up there too. So it could continue, man. XRP to BTC broke out. XRP to Ethereum, I think, broke out. They look splendid. And, that's great. They've only been taking L's for years, so it's their time. Daytime now. It's almost like, a team that is always last in the NFL. They always get first pick in the draft, and years of doing that long enough, finally they're decent again because they were just last for so long. We did it, man. We're gonna win the NFC East. We're gonna win the Super Bowl. But what were you doing before all that? Yeah, the Browns. Yeah, you were XRP, the Browns of the crypto market. You did it, man. But bro, crypto's gonna make it. You shouldn't care about Bitcoin, and you should just be bearish until we break 19,891.
One more step and this is the furthest away from home I've ever been.
Samwise, that's not true, man. You're actually, if we're talking about the analogy, Samwise is not leaving the Shire yet. He is still inside Hobbiton, inside drinking half pints of ale, simping on that girl Hobbit. That's you, Samwise, right now. Samwise, one more step would be right here. 19,850 or something. Just right before we break 19,891 and then the back test. Okay. So no, it's not true. Thank you, though. I appreciate the contribution. Hey, he doesn't want to leave the Shire. Not yet. I understand. Who would? Okay, chat. Well, it's been a fun stream. Sorry, the Jerome Powell speaking would be him speaking, not him interviewing a bunch of never will be's and never was. All right, pay attention. You know the levels. You've just seen what happened on the weekly across this market. But one thing you have to promise me is you're going to have a good weekend. You're going to relax. You should just have an alert set up at 19,891 on Bitcoin. That's about it, and leave it alone. Go outside, get some sun. Studies have been done that people exposed to sunlight, moderate sunlight throughout their life, have a higher life expectancy than people who do not get sun. Okay, so go out there, get some sun, enjoy time, build and strengthen relationships you currently have with your friends and family, your loved ones. And then we will just reconvene on Sunday for the weekly candle close on Bitcoin. Who knows where we'll be by then? But if we're below 19,891, you know what's going on. Real bad. Oh yeah, I forgot. I think I got a couple more requests. Just give me a second. Dang it, man. I was on a roll. It was a perfect outro right there. Now I'm ruined. There are multiple requests. Hold on. Tesla on the weekly for Josh. That was the next in line. Sorry. I'm so used to not getting requests anymore, tip requests, that I just, losing the muscle memory. He wants Tesla on the weekly. We'll look at it. Tesla on the weekly. Hidden bearish divergence. Very real. It was so bad you couldn't even bearishly engulf the last week's candle because you opened lower than last week's open and close. Bearish, nothing to do. Target is 209 on the weekly with bearish divergence, and you're not even in the bearish control zone yet. You're actually at neutral, which is kind of an anomaly. Most things are in the bearish control zones already. So 24% downside on Tesla in time if you're patient. You might very well catch a back test to 299 just to reconfirm the validity of the level as resistance. That's it. Okay, that's Tesla on the weekly. Thanks again. Josh, let's go to Uber for James B. Next on the list. Here's your Uber. Very, very bad, boys. Very, very bad. You're very well established. Beautiful. Beautiful. Downtrend. Guess what, Larry? False bearish breakout. Back inside. Lowest weekly candle close since July 25th. Confirmed weekly candle close below the low from September 2019, the low from July or June of 2020, the low from August 2020. You have broken that level. The next target is 2569 on Uber. You have a true bearish breakdown and at the same time false bearish breakout. Very bearish, man. And look, your target, you got about 7% downside before you see the next level. And then below that is the abyss for, 1986 and then 1382. That's the weekly, man. That's awful. I remember early in the week or last week or something, looking at it, Scott Carney was looking at it. It looked okay. No, it's not. It's terrible. Really, really bad. I know there was a bearish harmonic too, like a bearish crab or something. Hit type 2 and it's rolling over. Perfect. TA being respected. Okay. That's Uber for James. He says confirmed double top. It looks like it. Confirmation that the top is in is very, and you broke the neckline. You did with a weekly close. You closed below that neckline. It's awful, James. More downside now. Okay. Next request. LK NCY, a Chinese, Luckin Coffee scam. A virtual scam. It's been uptrending though since the COVID crash. Remember, this is the scam. They legit got caught cooking their books or whatever. It was really, really bad, dude. Really bad. And they bottomed out and they've been running. And in fact, you closed a couple weeks ago above the low from May 2019. I don't like this, man. I don't like it. You think, oh man, we broke the resistance, but no, well, you know what you're doing. You're probably confirming a top here. Don't be surprised if the top is getting put in right now. Bearish engulfing candle last week, follow through this week to confirm the validity of the bearish engulfing candle. No real bearish divergence. Well, on the RSI, there is. From the high to the same high, slightly higher high, lower levels in the RSI. Neither were even able to get to overbought territory. This is bad. And when you break 1543, you done, son. When you break 1543, straight down to 555. Look, why? Up, down, up, down, up. So have your alert set up on Luckin Coffee, just slightly below 1543, because when that breaks, it's bye-bye. We're talking 66+% downside when you break this level again. 64, 66, whatever. Okay. Massive downside potential on Luckin Coffee. And the breakdown level. Here it is. Okay. Scott, thanks, dude. All right, Josh sent me another. This is the last request on the list. Hey, man. All right, let's see. Kind of a weird request. Bitcoin to the US dollar to Tesla. Looks like an S coin. Certainly looks like an S coin. Okay, so we have this starting on the weekly. You have this weekly candle high close back from 2013 that you almost tested. I mean, you virtually did test it, but you did. There's a candle high close right here from 2017, and then more test, right? Correlation, September 2020. You fell below that. So it's all about, will this level hold? If it doesn't, you can clearly see what the consequences are going to be when Bitcoin to the US dollar to Tesla breaks below 59.96. It will be the same outcome you've seen every single time, where it's straight up, down, up, down, up. That's it. It's never done anything else really. So if you break 59.96 on this, you shall see 78 to 85% downside if history repeats itself, which it doesn't always. But my God, it's a great way to look at things, because of how many times does history repeat itself on all charts everywhere? All the time. So you are staring into the abyss. That's all I can say. And the abyss could be staring back. Josh, satisfied? There you go, man. I mean, there's not much more. Why would we care about the daily? This is perfect, man. The weekly is gorgeous, you know. You're in the bearish control zone. You're not oversold. There's some bullish divergence here. So, yeah, you might react. I don't care if you react. You're not going to take out the highs from October 2021 or April 2021. So what do you rallies and then eventually comes back and then breaks? Okay, so it's either sooner or later. Eventually, $60 probably going to break in these market conditions, okay? Or it just means how you, okay, the Tesla's dumping, but Bitcoin is collapsing. Daniel Pena levels of collapsing, right? Talking.
When it comes out, zero.
Or whatever his name, Michael Pena. I don't even know. The Pena guy, all right? The zero guy. Yeah, this chart is saying like, this is exactly where a reversal could occur. So Bitcoin could outperform Tesla for a while, right? On some sort of rally. So you're at the keyest of key levels. If you hold, Bitcoin's going to outperform for a while. But haven't you already been here? Could be the second low, one low, the second low with the divergence. I mean, you can't be surprised if at this is the level where a massive reversal occurs, or you break it and you go down 60, 70%, right? You're at the level. So critical areas, that is what we would consider this. Dan Pena, there you go. Daniel Pena, dude, whatever. I think there was a guy named Michael Pena who I went to high school with, and I always get confused because of that. All right. There you have it. Understand where we are on Bitcoin on the weekly. This is the W chart, the weekly. You've been here for months, flirting with this zone. But in the past 2 weeks, something different is occurring. You can't argue. It's undeniable. Which is, one more time to reiterate for anyone just tuning in, and this is for me to end the stream because it's your last moments with me. You have bearishly engulfed back below the previous cycle top. That's happened. Undeniable. Yes, it happened. June 27th. Yes, it happened. August 22nd. But both times, next weeks, after the bearish breakdown, right back above that level. But this time, there is no more break back above the level after bearishly engulfing or breaking below the level. In fact, this time, only bearishly back testing that level as resistance for the first time since we got here June 13th that week. So this is the difference. And unless something changes this weekend, which it'll be Rudy Poo anyway, but if nothing really changes this weekend, it will be, in 2 days, 4 hours, the lowest weekly candle close Bitcoin has received since November 23rd of 2020. Turkey sandwiches. Who wants the turkey sandwiches? That was the week of Thanksgiving, I believe. Yeah, it was. It was turkey sandwich week. Okay. So that is what I'll leave you with. Hope you have a good weekend again. Thanks for the likes, love, support, contributions, everything in between. Please be sure to join the Discord. I mean, like, come on, dude. Join the Discord. You're not going to get notified when I go live at random times like this. YouTube will not notify you. YouTube's having all kinds of problems, man. Super chats breaking down. They can't do that right. You join the Discord because we will 100% of the time notify you when I'm live at any time. Join it or be destroyed. Also, there's educational resources, and you're connected to like-minded individuals that also cares about traditional technical analysis. So if you want to better follow along with what I'm doing here, you join the Discord. Surround yourself with people that are like-minded, that care about the same things you care about, that have the same passions you have. And hopefully surround yourself with people that are at higher levels than you in whatever field you want to increase your knowledge in, right? That's what you want to do too. A lot of smart people, over 14,000 in our Discord. All right. So I'll be back. Have a good weekend. Until next time, respect the TA.